Hello, everybody. Good morning and welcome back to another Market Open. It is Tuesday, July 30th, 7:29 a.m. We are a little bit more than early, and that's because we've got PayPal and SoFi earnings on deck. So we're going to stream the SoFi call in about 30 minutes. So we'll be listening to Anthony Noto speak and see kind of what they have to say. But I want to go 30 minutes before the call around numbers around SoFi and PayPal. And then after the call, we'll transition right into the regular market open at 9:30. So let's get into the numbers and see what we got going on, especially in terms of what's going on with the stock. So real quick, before we get into the actual numbers, stock itself not making too much of a dent in the pre-markets. So SoFi right here, pre-markets is actually just turned green, 1%, up 8 cents, 741. So it's a triple beat. I'll get into the numbers, but market's really not that market doesn't care that much, at least not yet. And I'm going to go through the deck and I have some reasons why the market might not care that much, but market is not really saying, hey, this is like really exciting yet. Now, maybe that changes. It's definitely not saying it's bad, so it's not going down, but it's not saying this is like everything we want to see. So let's see how that turns out in the coming minutes going into the actual call. PayPal on the opposite side is up 4.82%. So PayPal triple beat as well, with SoFi had some stronger than expected guidance numbers, and that's why PayPal is getting some momentum. Not going to be sure if the market keeps this momentum for PayPal and SoFi, but at least as of today, today's a day before JPal speaks. S&P 500 right now in the pre-market slightly up. So I think the entire market is a little nervous before JPal speaks tomorrow. So not sure if a lot of these gains are going to be able to sustain themselves. However, the numbers are what matter, and the numbers themselves on PayPal and SoFi are pretty good, which is what matters. All right, so let's start off with SoFi and see what we've got going on. Thank you, everybody, for being here. Good morning. Good morning to everybody. Hope you guys had some coffee. Let's get into it. So SoFi, $599 million in revenues. That is a pretty strong revenue beat, which is not bad. 17 million in net income, 0.01 cent EPS. Some people thought they would bring in 2 cents. If they brought in 2 cents, I think the stock would be up closer to 4 to 5% right now in the pre-markets. They did not bring in 2 cents. It would have been really hard for them to put up 2 cents of profits. So 1 cent came in line with the expectations. That was good. And then 643,000 new members. This was also a little bit of a beat along with their guidance raise. And that's why I believe the street is, happy with the earnings based on what they have. Let's get into the presentation. And let's go deeper into what we got for SoFi. So member additions, 643,000, 41% year over year, 8.8 million members. Here's the one thing about members. SoFi right now up about 2%, 747, that I don't really love in terms of this metric is we don't know if these members are active or not. So, if I checked my SoFi app, once in the past couple of months, am I still a member? Do I still count as a member? I think if they included monthly active users, this 8.8 million would be significantly lower. And I say that because the net deposits, which we'll check in a second, also is not matching the level of net deposits you would want to see if you have these many users. So this metric always has been a little just like random to me, if there's not any substance. So I think monthly active users would make it a little bit easier to digest like the actual usage of the platform. But top line up 40% year over year, 8.7 million members, probably going to get to 10 million by the end of next year, which is good for SoFi and ultimately good for the flywheel that they have going on. New product additions of 946,000. That's up to 12.8 million, 36% year over year. So that's good. That's basically how many members are using the variety of different products that they offer in the product suite that SoFi has. Galileo accounts, 158 million. So you had 7 million quarter over quarter. I've never fully understood Galileo accounts. This is like for example, if every Robinhood user swipes their debit card issued from Robinhood, and Galileo is handling the transactions for that. If there's 10 million users that have Robinhood debit cards, are those 10 million Galileo accounts? I kind of think, yes, that's true. That's how they're getting up to this number. But this one is up 23% year over year, which is good. And it's getting back to accelerating, right? Because it was declining for the past 4 quarters. And now we're seeing the second consecutive quarter of an acceleration. We had last quarter go from 10 to 11. So 20 to 23, not bad in the context of Galileo account as well. Lending and financial services We've got financial service products up 39% year over year to 11 million, and lending products up 19% year over year to 1.8 million. Again, different suites of products, whether it's an auto loan, personal loan, home loan that you're giving out to your members that they're able to gain access to. So we have total 9.4 million financial services to lending products. And this is the breakdown: Replay, Invest, Money. So they have 2.3 million users using the Invest app. Credit card, 213,000. And then it's showing you Q2 2024, the difference between what they had last year. Now they have 12.7 million members. Invest has 2.33 million. Credit card, 261,000. Relay, 3.9 million. Then Money, which is like their loan services, 4.29 million over the past year. I want to see the deposit growth as well. Again, net revenue, 599 million, 597 million adjusted net revenue, 22% year-over-year growth. That's not bad at all for SoFi. Non-GAAP results versus guidance. So here's the guidance that they provided. In revenue, they put up 597 million adjusted revenue. The guidance was 555. So they beat on revenue. This is what SoFi historically does. 32 million beat at the high end. Adjusted EBITDA was 138, guidance of 115. So they had a 13 million beat at the high end, which is obviously not bad at the end of the day. We always know they kind of beat on this top level guidance. The big thing the street cared about was EPS. And SoFi right here up 1.64%, 745 in the pre-markets. EPS is just not beating at the levels the street wants it to, and it's not going to be able to, for at least a couple quarters. And I think that's why we're getting a little bit of a mute reaction in the stock. Q3 2024 guidance, we expect to deliver 625 to 645 million in adjusted net revenue, 160 million in adjusted EBITDA, and 40 to 45 million in net income, and 4 cents in EPS. So some decent projections if they deliver, 680 million next quarter, 180 million adjusted EPS, and maybe 5 cents of EPS. That potentially could be the quarter, along with rate cuts baked in from September, where SoFi explodes back up to like $9. But as of now, this result is not the strongest to get the stock moving a little bit in the pre-market. But the results are good. I'm not like, if you're a long-term investor, I think these results are pretty phenomenal, and they're doing what they need to do. Full year 2024, 800 million to $1 billion of tangible book value growth. Capital ratio over 16%. Adjusted EBITDA of 605 million. GAAP net income of about 185 million. GAAP diluted EPS of 10 cents. Financial services net revenue growth of more than 80% versus 2023 levels. Again, this is similar to their tech platform. Net revenue percent growth of mid to high teens versus 2023 levels. I think if they can focus a little bit more on this tech platform and the call, which I don't think they're going to do, but if they do that, maybe that starts to change the narrative of the multiple you give to SoFi on top of its tangible book value, given it's not just a bank, but it's a SaaS. But in this deck, they're really not stressing it too much. So on earnings, we're going to have to see in the call if they stress it as well. And then they're expecting 2.47 billion in net revenue. That's up from like 2.42 billion. So they increased that slightly as well for overall revenue growth. And there you go. How do you figure rate cuts will benefit SoFi? So I think there's two reasons. Number one, Noto has been very bullish on rate cuts and that CNBC interview. And the guidance they gave in Q1 was relatively conservative, given they weren't factoring in rate cuts by the end of the year. They were factoring more 5% unemployment and things of that nature. So if we do get 1 or 2 rate cuts, I think they raise guidance and they issue more personal loans because they get a little less conservative with their lending book. And that should beat on the top line and should beat on the bottom line if they were able to do that. And number two, there's just more liquidity in the broader system. So banks in general, regionals will benefit from that. You would imagine SoFi, that is a bank at the end of the day, potentially get some upside. The thing about SoFi, though, is that their tangible book value, they're already trading at a premium above tangible book value versus some of these other banks. Now some of these banks are trading at that premium because they've run up. But that is the existential question with SoFi, is that if it's a bank, well, what premium does it get against tangible book? And if it doesn't get a massive premium, then 850 might be the top of where it kind of sits at. Now, if things get really frothy after that rate cut, I think SoFi gets closer to $9 or $10. But I don't know if the actual growth will be able to justify those numbers. And it's a question of, do you value it as a SaaS, right? Do you value it as a tech company that's growing 22% year over year, put a tech multiple like a Palantir, or do you value it as a bank that, even though it's growing, way quicker than Bank of America, it still needs to be adjusted for the risk that a bank has, which is delinquencies, credit defaults, etc. PayPal Q2 revenues of $7.9 billion versus expectations of $7.14 billion, beating by 10%. EPS of $1.19 versus expectations of 89 cents, beating by 34%. So PayPal beats pretty nicely, revenues and EPS. I'm going to pull up their deck right now. It's actually a triple beat, and Kris tweeted just now as well, saying that he's pretty damn excited based on the numbers that they put out. So $1.5 billion of free cash flow PayPal put up, raised guidance, 9% revenue growth, and their non-GAAP EPS is up 36% as well. So here's what Kris said. He said, PayPal delivered a strong second quarter and first half, and I'm confident we are on the right track. We are operating from a position of strength, delivering for our customers and focusing on long-term profitable growth. Let me know if you own SoFi or PayPal in the chat. PayPal right now in the pre-market, SoFi 740, PayPal up 5%, 61.85. Currently, it was about 57 yesterday. All right, so what do we got on PayPal? Total payment value for volume, $416 billion. That's up 11% year over year. That's how much money is actually being transacted through the entire PayPal ecosystem of and networks. Revenue, $7.8 billion. That's up 8% year over year. Transaction margins, $3.68 billion. That is also up 8% year over year. Free cash flow, $1.3 billion. Non-GAAP EPS of $1.19. That's up 36% year over year. So really the bottom line is starting to get some momentum from some of the new products they announced back in January that they're putting out. Monthly active accounts, 222 million users. That's up 3% year over year. Active accounts, 429. That's flat, 429 million globally. That's year over year flat. Number of payment transactions, 6.58 billion. That's up 8% year over year. That means 6.58 billion times people use PayPal to buy something. Transactions per active account. This one is actually the most important metric, I think. It's like how many people are actually transacting based on the accounts that you have. And it's 61, which is up 11% year over year. So they're getting a decent amount of engagement on those actual active accounts. And then 34.2 transactions versus unbranded card processing, which is up 6% year over year growth as well. Monthly active users driven by Venmo and PayPal consumer accounts. TPA is 11% driven by Braintree. And then active accounts is primarily driven by a lower churn, which is a little bit more of a problem they had in Q2 of 2023. So not bad. I mean, those are top line results, which is really not bad at all. Guidance for 3Q, mid-single digit revenue growth, probably 7 to 8% again. Non-GAAP EPS, high single digit revenue growth, probably around 8 to 9%. And then GAAP EPS of 96 cents versus 98 cents as well. Now, they're also increasing their share repurchases to $6 billion. This was before $5 billion. So now they're buying back another $1 billion worth of stock. I think Steve, who's been coming on the channel and been saying, hey, these guys need to buy back more stock. He's going to be very happy that it's time that they're at least starting to buy back a little bit more stock. But they are really getting to the point where they are buying back 10%, a little bit more than 10% of the entire float. PayPal right now, 555 or up 5.55%, 62.21 in the pre-markets. And I think that's also another exciting thing that we got from PayPal. Free cash flow, again, of $6 billion they're projecting for 2024. Previous estimates were $5 billion. Same thing with share repurchases. Instead of $5 billion, they're buying back $6 billion of stock, which is, again, not bad at the end of the day. So they're increasing top-line users. They're increasing active transactions per accounts. They're increasing their transactive margins, and then they're buying back more stock. I mean, it's a quarter from SoFi and PayPal that if you're the street, the only reason you're not really giving them any love right now is because J-Pow speaks in 24 hours and you're a bit afraid that he might say something that ruins the entire market. If you don't think he's saying anything that's going to ruin the market, I don't think you're super afraid to necessarily dabble your toes into PayPal or SoFi. Here's PayPal's diluted shares outstanding. So you went from 1.9 billion back in Q1 2021 to 1.047 billion. They repurchased 25 million weighted average diluted shares during Q2. So it's kind of crazy that the stock is under this much pressure and they're buying back almost 25, 26 million shares a quarter. Like there's so much buying pressure and so much of a bid on those shares. You would imagine what would happen if there wasn't that buying pressure from PayPal. I mean, would this thing be in the 40s by now? So they're buying. The street is at least keeping them afloat based on the buying. Now is going to be the question of when the street expands a little bit more, the multiple that SoFi and PayPal has, based on some of these results. PayPal was an Elon company at one point. Yes, that is also true. I think X is going to launch some type of payments competitor eventually. PayPal up about 6% right now. So PayPal really showing a strong earnings. SoFi up 1.5%. And the reason for that is because they're hiring payment engineers for something called X Payments. So you would imagine in the next probably year, they launch a product that allows you to pay via Twitter. It makes sense. Twitter already has, people are already at Twitter doing stuff anyway. So the question is going to be then how competitive can it get, with the 500 million users they have, and do people trust sending things through PayPal? But in general, that will be one product suite that I think they offer. I just don't think it's going to put a dent into PayPal, given how big PayPal is. Same thing with Apple Pay, dude. Apple Pay has not stopped PayPal. Apple Pay it's just been a regular. It's just been PayPal. I mean, it's just been another product, but it's not stopped PayPal from executing. And these numbers definitely show that it's not stopping their execution either. So overall good quarters, man. Overall pretty damn good quarters. Maybe like a TikTok shop. Yeah, exactly. I mean, X should be selling tons of product. There's so many different ways they can innovate. Their advertising revenue is down around 80% year over year. And so given their advertising revenue is down, they have to find different ways to diversify revenue streams. Premium memberships, not just enough to make up for the loss. So I would imagine there's some type of commerce or payments platform they launch. What do you guys think? What do you guys think about these earnings? SoFi stock not really reacting. SoFi up 1.36%. Maybe I don't know why SoFi is being stubborn. It usually goes down 5% or up 5%. It's kind of just flat right now. Nothing too crazy. I want to see how many deposits they brought in as well. Total deposits grew 6% in the second quarter to 23 billion. What are the exact number of deposits? Is it 3 billion? Deposits are, I can do the math right now. Deposits are 231 million in the past 3 months. No, that doesn't make any sense. 230. That's a wrong number. That's weird. You would think they have deposits right up in front. I'm trying to find that. Does anyone have that number? I think it's like 3.02 billion or something. But yeah, the stock really not moving that much based on these numbers. At this point, it's nice that SoFi's not, tanking, because every earnings it does that. Now maybe it does when the bell opens. We'll see. There are still a ton of, 180 million shares short. Someone borrowed 20 million shares yesterday as well. It was shown after hours. And usually when you borrow shares, you're going to short it. It doesn't mean you have to short it, but they borrowed 20 million shares, bro. And if they borrow 20 million just to short, that would not be the best either. Yeah, why don't they have the exact number of deposits, bro? That is weird. Does anyone have the deposits number? I don't have the deposits number. Amid tomorrow's the inflation decision, the pattern the market has before the Fed decision. Yeah, so I expect a little bit of more volatility today in the broader markets. I expect the VIX to spike up a bit. But if by the end of the day, the market kind of rebounds and we see some momentum, maybe it's because Jay Powell, it got leaked, his message to the American people, which is that, hey, rate cuts are coming soon, which is, it didn't get leaked last time, but it felt like it got leaked last time. So we'll see what Jay Powell ends up saying. It is a triple beat for SoFi, correct, and for PayPal. Triple beat for SoFi and for PayPal. We also have some other earnings on deck as well. Let's do this one real quick. We have Procter and Gamble earnings. Let's look at them real quick. And then we've got SoFi's call in 12 minutes, starting with Anthony Noto.
Procter & Gamble reporting earnings of $1.40 a share. That was 3 cents better than estimates. Revenue of $20.53 billion, just shy of estimates. Join us now, Procter & Gamble President and CEO John Mueller. Always so many things to delve into, John. Can I good to see you, and welcome to the show.
Likewise.
You're not. I wish you were right here with us. But for the first time, would you say
Procter Gamble's down 4% on these numbers?
that There is some pressure on consumers, whether it's pricing, perhaps whether it's in China, to account for this. I know there's currency headwinds, there's commodity cost headwinds. It's always a very detailed report with a lot of numbers. But what really happened? And are these good numbers in your view?
Well, first of all, I'm looking forward to seeing all three of you in Paris tomorrow, and we can catch up on even more detail at that point. But we just finished our fiscal year. I'll come to the quarter in just a second. The fiscal year, we guided to 4 to 5% top line growth. We delivered 4. We guided to 6 to 9% core earnings per share growth. We delivered 12, which is 16% on a constant currency basis. Cash flow, free cash flow productivity, 90% guidance. We delivered 105, which allowed us to increase our dividend by 7%. That makes it the 134th consecutive year this company's paid a dividend, and the 68th consecutive year we've increased the dividend.
Okay, so Procter & Gamble results aren't the best, which is why the stock is down. Again, this is a leading consumer company. Obviously, Procter & Gamble, you guys probably have bought some of their products. So that's down 4%. We'll dive deeper into their numbers later. But that is a little bit of an argument that, hey, the consumer is starting to weaken. And again, wow, PayPal up 6%, not bad. It's going to show to the broader, Fed that if Procter & Gamble is not able to sell as much as they were selling in the past, maybe we do need to seriously think that the consumer is starting to get tight, that no one's going to buy a damn house with a 7% mortgage, and it's time to cut rates. I think, again, it is. I said yesterday on the stream, I would eat a bucket of mayo if the Fed raised rates. So, I'm not eating that bucket of mayo. So J-Pow better not raise them damn rates. But I think a cut would be premature. I think a cut is needed, but I don't think they're going to do it in July. But they're definitely not going to raise. And as a result of that, I just think that September, we're going to see a nice cut. And it seems inevitable at this point. If they don't cut in September, we are screwed. SoFi is screwed as well. SoFi needs this cut. But I think in September, we're going to get this cut. So I don't know. The stocks really, again, SoFi stock, Adam right here says in the chat, if Noto is hyped and stand on business and actually sounds alive and excited about projections, SoFi will pop. We got 10 minutes of the call. I hope so, bro. Noto doesn't usually sound excited on these calls. And it's kind of weird when, every morning I wake up and I try to sound excited and energetic and ready to talk and, get into the market open. And even if I'm not personally the most excited, because not only is it a job, but it's an honor to even be able to do this. And so I'm excited every morning. Right. And I'm happy to be here. You talk to the public 4 times a year on this investor call. If you're a CEO, how do you not sound exciting? Right? How do you not sound like you're serious about the bit? It just baffles my mind how you could be so boring on an earnings call. Now, if you have a bad quarter, I get it. But I would be even more excited if I have a bad quarter. We missed revenues by 10%, folks. But no, I'm kidding. But I would start highlighting we missed revenues, but our member growth is absolutely exceptional. And what we're doing to really increase the top line revenue growth over the next 4 quarters is going to be, I would start getting into my zone, right? You would think, oh my God, this guy just crushed earnings the way he's talking, right? That's how I would be doing it. So it's unfathomable to me that you're a public CEO, billions of, public investors or billions of dollars from public investors are pouring into your company, and you're boring on the call. Your company can definitely hire a communication coach. You don't have to be boring forever. On top of that, someone was saying, oh, well, in California where Noto lives, it's like 5 a.m. I don't care. Are you kidding me? This is an $8 billion company. Who cares if it's 5 a.m.? Wake up early, get some coffee. That can't be an excuse for being boring. So I really hope he's not boring. Because seriously, and I know a lot of people say, oh, it's only about the numbers, dude. It's not only about the numbers. Tesla, quite frankly, I think tanked. Tesla pre-market right now. Wow, Tesla's up another 1%. Tesla tanked on earnings because of Elon's lack of excitement, in my opinion. Because the numbers weren't anything horrible that the street didn't expect. It wasn't the best, but it wasn't oh my God, they missed so badly. It's no, we kind of knew these numbers would suck. But Elon just sounded bored during the call. Again, people trade on emotions, right? SoFi CEO, when he said, hey, I'm voting for Trump and I don't care, basically said that. I think there's a certain segment of the population that sold the stock that day. They said, screw this guy. There's another segment of the population that bought it. And, but at least you felt like, oh, this guy actually just like, he's speaking his mind at this point. Like he's not caring too much, even if to the detriment of the company. You're seeing some balls on the guy. And like, and at the end of the day, that's what you need to really build a generational company for the long term. And I hope on this earnings, we finally see that as well, because we didn't see that last earnings at all. We definitely didn't. PayPal right here, about to touch 63, up 6.65%. So the market really liking PayPal, not really caring about SoFi. Not once has Noto spoke boring. Oh boy, I don't think you heard that last earnings call, dude. But yo, if you heard the last earnings call, put in the chat if you thought he was boring or not. I mean, dude, this guy was like, it was bad. It was not good. I remember the last earnings call. First of all, they spent like 40 minutes reiterating the PowerPoint that they put out. It's like, that was absolutely pointless. No one cared about that. And then in the Q&A, they just weren't excited. Chris Lapointe wasn't excited. Noto was. It was bad, dude. It was not a good call. Even Tanner admitted that. Obese Tomato, thank you for the $5 super chat. Noto should pull a carp and attack the shorts and their coke habits. I think so as well. I think, the lawyers probably are saying don't do it, but sometimes you got to go a little off script, bro. Sometimes you have to. I think sometimes you have to. And again, Noto has a lot of respect. I have a lot of respect for Noto. The problem is he is not able to inspire in the way that I think someone like Alex Karp is able to inspire. And if he can do that, I really do think sentiment around the stock changes. Like, people underestimate how important, we got the call in 5 minutes, how important it is to have a CEO speak their mind and get people to care. Elon and Karp are prime examples of people that have done this. So I don't know, even someone like who am I thinking of? Toby Luke from Shopify, right? Founder, CEO. This guy as well, just absolutely accepted. Brian Chesky from Airbnb. I mean, these guys inspire you with a vision, even if their stocks are not doing well, and they figure out how to get people to care. So I think Noto's got to do that. Noto was being Noto. That's fine, bro. But if Noto being Noto means he's boring, Carl says he wasn't just boring. He was boring as fuck. Yeah, let's like, come on, bro. This is like 4 times a year you get to talk to your investors like directly. Like, you got to get up for those days, bro. You got to get up. You got to be on your game on those days. And even if the results aren't amazing, which these results are pretty damn amazing, you did the hard part. You got the good results. Now you just got to sound excited about it. And I think that's important. You didn't hear what you wanted to hear. That's all. And you was saying that he should say wild shit like Karp. LOL. Noto is attached to a bank, people's money, and not a. Well, if that was the case, why did Noto say he's voting for Trump? Right? Like, this is what I'm saying. You can't have, like, you can't say Noto is not trying to like be out there and cause headlines. Like, he would have not answered that political question then. There is no reason Anthony Noto should have said, I'm voting for a Republican administration if he's attached to a bank. And because he's attached to a bank and he's attached to people's money, there's more than just Republicans that have money in his company. I'm sure there's plenty of Democrats that have SoFi accounts. I think the reason he did it that day is because he wanted to send a statement to the market that we really need Trump to win for us to get a healthier capital spending environment for SoFi to go up. And if you're going to go, and some people thought it was desperate, saying, oh, you want a Republican president just for SoFi to do well, which is basically what he said. I don't think it was desperate. I could understand how it's misconstrued as desperation. But if you're going to go that far to like make an argument for SoFi, why don't you actually just like talk about SoFi in a more exciting way versus saying, hey, we need the Republicans to win so SoFi has more liquidity? Because I can make the argument for why that was like not the most exciting way to talk about it, even though I personally like that he was being more explicit. But I think if you're going to talk about your politics, you might as well talk more explicitly and characteristically around SoFi and get people excited about this thing. Crossroads, shout out to you. Happy PayPal earnings to those who celebrate. Yes, again, PayPal crushed it. We talked about their earnings. I don't think we're going to be able to stream the call because it's the same time as SoFi. PayPal earnings, PayPal call. Let me check right now. I think it's at 8:30, so we'll be in the middle of SoFi's. But I'll give you guys updates on what Kris says in the quotes and be putting it in the chat as well. So let's see. Let's see what happens in 2 minutes. Amit, did you see Peter Thiel on the Trigonometry podcast? Pretty juicy chat. Yeah, I saw a couple of clips of that. I'll share some of those clips as well in the coming days. I thought that was a really interesting podcast. He talked about the threat of China and a variety of other things. So yeah, that was an interesting one. That one just came out yesterday for those that did not see that podcast. Thiel has been doing a lot more podcasts. He's been out there publicly. He's been actually talking to the press. So nice to see Thiel getting out there. Mid opinion on Starbucks. The recent pullback brought them to my target price range, so I've opened a small long position. I do feel like Starbucks is starting to be a bit more undervalued. However, I would be very cautious buying before earnings, because I don't know if they've done enough in the past 90 days to change the business. I mean, I still go into Starbucks and the coffee is ridiculous, like in terms of price. If it hasn't changed in 90 days, I don't think member subscriptions went up. I don't think revenue necessarily went up. The China headwind is still there. So kind of like CrowdStrike, which is down again because Delta hired this big law firm and they're going to try to sue the crap out of them. I think it's a wait and see for Starbucks and CrowdStrike before you go long. Like if you get Starbucks at 60, 65, that would be, a way better entry price and way more adjusted for the risk. Same thing like CrowdStrike. If it falls to 180, 200, I think that's going to be a lot more exciting than buying here at 250. So I would wait on Starbucks because there's just too much unknown right now in the past 90 days for them to have changed too much. Okay, so I should be live in about 30 seconds. SoFi price right now, 745, up 1.64%, and then PayPal up 6.06%, 6.1, 62.57 on PayPal. Have you seen Serve run? Yeah. Again, this is because Nvidia bought an equity stake in them. That's why Serve has been doing well, but it's up 14x in the past month, so I would be careful of hopping into that one as well. Can't wait for business banking at SoFi. I agree. I mean, if they had a business bank, I would have opened an account with them a while ago. I have an Invest account, but I have Bank of America for Business.
For the SoFi Technologies Q2 2024.
All right, here we go. We're live, folks. Here's SoFi's Q2 earnings call. Okay, we should be starting. I don't know why the guy interrupted, but then they played music. So it should be starting soon. You should have a split stream with the stock start. Unfortunately, StreamYard doesn't allow it. That's the annoying part. PayPal, I think, is at 8:30, Matt. If it's now, then you're going to have to go to a different channel because we're doing SoFi here. But probably not going to be able to do PayPal. Zoko, good morning. Midwest, what's up? Okay, why aren't we starting? I think we should be starting soon. I guess we're not starting. Never mind. I guess we're waiting. To calm you down without having to pay the royalties. Yes, exactly. SoFi triple beat. Triple beat, stocks flat. And now we're waiting for the call. This music feels like it's like 2009. Like, who picks the music for these earnings? Dude, I would pick some gangster shit before the earnings call. I would play like Who Shot You or some shit before the earnings. I'd jump in there like a boss, bro. Boring bank music. Sounds like my music my kid listens to. United Airlines picks the music. All right, here we go.
Good morning, and my name is Adam, and I'll be your conference operator today. At this time, I would like to welcome everyone to the SoFi Technologies Q2 2024 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by 1 on your telephone keypad. If you wish to withdraw your question, please press star followed by 2. Thank you. With that, you may begin your conference.
Thank you, and good morning. Welcome to SoFi's second quarter of 2024 earnings conference call. Joining me today to talk about our results and recent events are Anthony Noto, CEO, and Chris Lapointe, CFO. You can find the presentation accompanying our earnings release on the investor relations section of our website. Our remarks today will include forward-looking statements that are based on our current expectations and forecasts and involve risks and uncertainties. These statements include, but are not limited to, our competitive advantage and strategy, macroeconomic conditions and outlook, future products and services, and future business and financial performance. Our actual results may differ materially from those contemplated by these forward-looking statements. Factors that could cause these results to differ materially are described in today's press release and our subsequent filings made with the SEC, including our upcoming Form 10-Q. Any forward-looking statements that we make on this call are based on assumptions as of today. We undertake no obligation to update these statements as a result of new information or future events. And now, I'd like to turn the call over to Anthony.
Thank you and good morning, everyone. Our second quarter results were exceptional and continue to demonstrate SoFi's leadership as a one-stop shop for digital financial services and the amazing grit of our team. I'll cover 5 topics before turning to Kris for a deeper look at our financial and operating performance. First, our strategy continues to drive strong, diversified growth, profitability, and returns. Second, our continuous product innovation and brand building are fueling significant member and product growth, which are key to our long-term revenue and profit growth outlooks. Third, turning to our segment results, our financial services segment demonstrates our clear structural advantages in delivering value to members. Fourth, our leadership and agility in lending has generated sustained returns despite rising rates and positions us to move quickly once rates come down. And finally, our tech platform is making good progress on its journey toward becoming the AWS of not only fintech, but of financial services broadly. Turning to the first topic, the success of our one-stop shop strategy. For Q2, adjusted net revenue reached a new record of $597 million, a 22% year-over-year increase. Our rapid diversification made a record revenue quarter possible, even with just 5% growth in adjusted net revenue in lending. Combined, financial services and tech platform revenue grew 46% year-over-year and now makes up 45% of total adjusted net revenue, up from 38% 1 year ago. To put that accomplishment in context, lending now stands at just 57% of adjusted net revenue, compared to 99% of our revenue when I joined nearly 7 years ago, and more than 70% of revenue just 2 years ago. We also delivered even greater growth and profitability in the quarter. EBITDA grew 80% year-over-year to $138 million. We recorded our 3rd consecutive quarter of GAAP profitability with $17 million in GAAP net income versus a loss of $40 million in Q2 of 2023. Credit performance was better than expected as cumulative fair value adjustments from delinquent loans peaked in March, along with delinquencies on an absolute and percentage basis. We are really encouraged by our team's ability to bend the curves through stringent underwriting, limiting credit exposure when prudent, and improving collections and servicing. Kris will share details on the performance of our recent personal loan vintages, which show clear improvements versus older vintages, underscoring our confidence in our prior guidance around life of loan losses peaking in the 7 to 8% range. Our loan sales continue to scale at attractive execution levels with an increasingly diversified set of buyers, with $1.6 billion in total sales this quarter and $4.7 billion in the 3 trailing quarters. This brings me to my second topic. Our rapid pace of innovation and brand building are fueling significant member and product growth. The growing size of our member base and the number of products they use impact the results we're reporting today. But more importantly, they are the leading indicators of our potential revenue growth and profitability in the future. In Q2, we added 643,000 members and now have 8.8 million in total. That's up 41% year-over-year. We grew products in the quarter by 946,000 to 12.8 million in total. That's up 43% year-over-year, adjusting for our exit from crypto last year. Nearly 40% of all new products in Q2 were opened by existing SoFi members. We also see that nearly 30% of new members open a second product in the first 30 days, demonstrating the immediate value of our one-stop shop strategy. We've doubled our member base and number of products in the past 2 years, and Q2 was the 20th consecutive quarter of greater than 30% growth. Our growth in members and products will drive our financial growth for years to come, and is the basis for our 3-year financial outlook shared at the end of 2023. All this growth is a direct result of our relentless focus on innovation. Because we offer products across 8 categories, compared to many fintechs that only offer 1 or 2, the magnitude of our innovation is not always obvious. As much as I'd love to share the full breadth of what we shipped in the quarter, I'll just cover a few of the highlights. I'll start with our financial services business, which drove 91% of our new product adds in the quarter. Our Invest offering is getting better every day. In fact, I don't know of any other self-directed product that offers alternative assets like private credit, private real estate, and private venture investing side by side with fractional shares, robo-funds, ETFs, and IPOs. Our innovations over the last year are starting to accelerate results, driving a 58% year-over-year increase in assets under management in our Invest business in Q2. And this was driven largely by net flows. We fully rolled out alternative assets and mutual funds, including interval funds from well-known financial leaders in KKR, Carlyle, Franklin Templeton, and ARK Venture Fund, which includes several leading private technology companies. Alternative assets generated 12% of all net flows during the second quarter. We brought the concept of one-click checkout to individual asset transfers, enabling our members to consolidate their assets the way they would like, and now we're seeing benefits from that innovation as well. We are now finalizing a turnkey way for companies going public to extend participation in their IPOs at scale to their customers, employees, and partners. With this new directed share program, people can open an account, enter an order, and fund it in minutes without fees, minimum balances, or speaking to anyone in order to participate in an IPO. Turning to SoFi Money, in the quarter, we launched Zelle, one of our most requested features and one element of our much larger money movement product pipeline. The innovations in our member business unit, which focuses on ensuring our products work better when used together, are reaching critical mass. For example, 3 million members have signed up for SoFi's broad-based rewards program. We're creating a rewards economy across our products, including rewards for using our app and other services, and we're expanding redemption options, including into stocks, cash for savings, and travel. For SoFi Plus, we achieved 1 million members. For people that are not familiar with SoFi Plus, it is our premium membership tier available to those who enable direct deposit. SoFi Plus includes our highest APY on banking balances, which today is up to 4.6%. It also includes up to 2x reward points, up to 3.3% cashback rewards on SoFi credit spending, discounts on personal loan rates, and much more. And I'm very excited to share that we've laid the foundation to provide more value in SoFi Plus, not only to direct deposit members, but also a monthly paid subscription product for those who prefer that option over direct deposit. We intend to test this new subscription-based option for SoFi Plus later this year. We're also driving iteration and learning to drive innovation in credit cards. We improved our acquisition capabilities and introduced a 10% cashback boost for SoFi Plus members that has shown positive results. And I'm excited to share that this week we'll also begin testing 2 new credit cards to better serve our members' needs. One card for cashback rewards on everyday high-spending categories, and one for members who need a no-frills card with no surprise fees. Turning to lending, we've launched new capabilities that position us for future growth, especially as the rate environment improves. In small and medium business, members can now apply for a loan at SoFi and get approved offers from lending partners. In home loans, we can now close our home equity products instead of brokering them out. This dramatically increases our potential for revenue per loan. Notably, we're now a principal in home equity loans and can offer members a lower cost of borrowing in these secured loans compared to higher rates in unsecured lending. And of course, our tech platform is a center of innovation as we add capabilities to our already comprehensive offering. We expanded our buy now, pay later product for post-purchase use. We added new wire capabilities and extended the AI-driven transactional fraud capabilities in our payment risk platform to non-processing partners. We also advanced the quality of our managed service in the cloud and introduced 3DS, which adds another layer of security to digital card transactions. These improvements ensure our modern, cloud-based platform will continue to serve the needs of brands, fintechs, and global financial institutions alike. Having world-class products is a necessary factor in becoming a top 10 financial institution, but it's not enough. We must also become a trusted household brand name. We measure this by our unaided brand awareness. Our world-class marketing team stands in a category of one. Their amazing work has increased unaided brand awareness to the 7 to 9% range, which is up about 40% year over year and 4x since 2021. Our brand punches way above its weight as our team continues to make its footprint bigger than its foot. Now diving into our segment results. In financial services segment, we are seeing the continued benefits of structural advantages that drive our leading value proposition. We reported record segment revenue of $176 million, up 80% from $98 million in the year-ago quarter. Importantly, this drove contribution profit of $55 million compared to a loss of $4 million 1 year earlier. Financial services products grew $865,000 in the quarter, up 48% year over year, adjusting for our exit from crypto last year. Revenue per product grew 8% quarter over quarter and 29% year over year. We believe there's substantial upside to the monetization of our financial services products. SoFi Money achieved new records this quarter as ending deposits totaled $23 billion, with consumer deposits up $2.2 billion from the previous quarter. Account openings grew by 419,000, and 90% of our deposits remain tied to sticky direct deposit relationships. Debit spend also continues to increase at a rapid pace, up 129% year over year, and now annualizing at about $9 billion. Our credit card and invest businesses remain in investment mode with nearly $100 million in annualized losses, but we expect them to follow a similar path to Money in achieving variable profit and contribution profit. In our credit card business, delinquency entry rates and roll rates improved by roughly 20% apiece from 2023 averages. Turning now to my fourth topic, our strong leadership across lending. We reported strong results despite our conservative posture, given a 500 basis point increase in benchmark rates over the past 2 years and continued macro uncertainty. Importantly, net interest income reached an all-time high of $279 million, or 82% of lending revenue versus 72% 1 year ago and 45% 2 years ago. Net interest income is cash revenue. Let me say that again. Net interest income is cash revenue, so 82% of our lending revenue is cash. Notably, discount rates and spreads were largely unchanged and in aggregate had a slight negative impact on lending revenue. Our personal loan originations reached a record of $4.2 billion while sticking to stringent underwriting standards as our team demonstrated its grit by consistently iterating on pricing and marketing throughout the quarter. Our home loan originations were their highest since Q1 of 2022, growing 24% quarter over quarter and 71% year over year, despite interest rates at their highest level in 10 quarters. On top of that, purchase home loan volume was our highest ever, growing 25% from Q1 2024 and nearly 100% year over year. Once rates come down, we expect to benefit from our expansion into 3 products in home lending: purchase loans, home equity loans, and the volume already generated by our financing business. Student loan originations grew 86% year over year. The team drove our strongest Q2 of origination volume in 3 years by iterating to drive continuous improvement throughout the quarter and into Q3 with private loan refinancing, which exemplifies our ability to respond to environmental factors to drive results. And my fifth topic, the tech platform segment is making good progress on its journey to become not only the AWS of fintech, but of financial services more broadly. We recorded segment revenue of $95 million, up 9% year over year, and contribution profit of $31 million, up 82% year over year at a 33% margin. This represents our 4th consecutive quarter of over 30% margin. Our customer wins have been more diverse, including but not limited to secure card and B2B partners. Our pipeline of interest remains robust, and includes U.S. and international financial institutions, along with major consumer and commercial brands. As we have noted, we are pursuing enterprise partnerships with larger existing customer bases for more durable revenue opportunities. These partnerships take multiple quarters, not months, to win, and have even longer integration cycles due to their size and complexity. In closing, the quarter was exceptional. We continue to demonstrate a record of strong, diversified growth, even in uncertain times. The performance of our leaders and the grittiness of our team was the best I've seen in my 7 years here. Suffice it to say, I cannot wait to see what we achieve in a better climate. Combining our high member growth and product innovation with lower benchmark rates, unemployment at 4 to 5%, stable inflation, and a stable economy, I could not be more confident in our ability to achieve our ambitions. With that, I'll turn it over to Kris for a deeper look at the results.
Thanks, Anthony. The second quarter was underscored by continued execution, profitability, and increased diversification. Strong evidence of how our differentiated business model drives SoFi's durability and long-term growth potential. I'm going to walk through key financial highlights and our financial outlook. Unless otherwise stated, I'll be referring to adjusted results for the second quarter of 2024 versus second quarter of 2023. Our GAAP consolidated income statement and all reconciliations can be found in today's earnings release and the subsequent 10-Q filing, which will be made available next month. For the quarter, we delivered record adjusted net revenue of $597 million, which grew 22% year over year. Adjusted EBITDA was $138 million at a 23% margin. This represented over 7 points of year-over-year margin improvement, demonstrating significant operating leverage. In fact, sales and marketing declined as a percentage of adjusted net revenue by 6 points relative to the year-ago quarter. We delivered our third quarter of GAAP profitability, with GAAP net income reaching $17.4 million, a $65 million improvement year over year, and GAAP EPS of 1 cent per share. Now on to the segment level performance. In lending, we achieved adjusted net revenue of $339 million, with $198 million of contribution profit at a 58% margin. These results were driven by 20% year-over-year growth in net interest income, while non-interest income was down 38% as planned. Growth in net interest income was driven by a 40% year-over-year increase in average interest earning assets and a 27 basis point year-over-year increase in average yields. This resulted in an average net interest margin of 5.83% for the quarter, up 9 basis points year over year. In terms of non-interest income, Q2 originations grew 22% year over year to $5.3 billion and were driven by a record quarter in personal loan originations, which grew 12% year over year and 28% sequentially to $4.2 billion. Our student loans business saw origination volume grow 86% year over year, with a slight 2% decline sequentially to $737 million. Home loans grew by 71% year over year and 24% sequentially to $417 million. Our personal loan borrowers' weighted average income is $168,000, with a weighted average FICO score of 747. Our student loan borrowers' weighted average income is $137,000, with a weighted average FICO score of 764. In the second quarter, we sold portions of our personal loan and home loan portfolios totaling nearly $1.6 billion. In terms of the personal loan sales, we closed $1.1 billion of principal at a blended execution of 106.2%. These sales had similar structures to other recent personal loan sales, with cash proceeds in line with par or at a small premium to par, with the majority of the execution premium consisting of a contractual servicing fee that is capitalized. These deals included a small loss share provision that is above our base assumption of losses and immaterial relative to the exposure we would otherwise have if we held the loans. Our $381 million of home loan sales were sold at a blended execution of 101.9%. Additionally, we sold $69 million of late-stage delinquent personal loans in the quarter. We noted last quarter that we typically have not sold delinquent loans until such time that they are charged off. However, we've been able to generate positive incremental value in these sales, relative to selling after they charge off, both from our improved recovery capabilities and by maintaining servicing. Finally, we executed $989 million of senior secured financing, which will show up on our detailed balance sheet as senior secured loans held for investment at amortized cost. These loans have a fixed term structure and are secured against the underlying assets, therefore equivalent to investment grade bonds if you were to do a securitization for the same pool of collateral. In addition, these loans are priced at market rates, which not only helps to diversify our balance sheet, but also provides an additional return above our cost of funding and a yield similar to the net interest margin of our loans, which are unsecured. Turning to credit performance, our on-balance sheet 90-day personal loan delinquency rate was 64 basis points in the quarter, a decrease from 72 basis points in Q1, which is evidence of surpassing a peak. Our personal loan annualized charge-off rate increased to 3.84% from 3.45% in Q1 2024, including the impact of asset sales, new originations, and the delinquency sale in the quarter. Had we not sold these late-stage delinquencies, we estimate that including recoveries between 90 and 120 days delinquent, we would have had an all-in annualized net charge-off for personal loans of approximately 5.4%. For our student loans, our on-balance sheet 90-day delinquency rate was 12 basis points versus 13 basis points last quarter, while our annualized loan charge-off rate was 64 basis points. That brings me to an important point, an in-depth look at cumulative net losses on several of our personal loan vintages and how this underscores comfort in our 7 to 8% maximum life of loan loss assumptions in line with our underwriting tolerance. As you can see on page 8 of our investor presentation, a loan vintage analysis indicates the following. Using our 2017 vintage as a starting point, as this is the last that approached 8% life of loan losses at 7.85%, you can see significant improvement in cumulative net losses at a given percentage of remaining unpaid principal for more recent 2022 and 2023 vintages. Specifically looking at the Q4 2022 vintage, soon after we made material cuts to credit, at roughly 40% of remaining unpaid principal, net cumulative losses of 5.02% are well below the 6.07% observed in the 2017 vintage at that same point of 40% remaining principal balance. In addition, you can see that more recent vintages are performing as well or better than the Q4 2022 loans at similar levels of remaining unpaid principal. This is critically important as this analysis and comparison gives us confidence that our loans will continue to perform in line to better than our tolerance. Furthermore, looking at page 9 in the investor presentation, you will notice that only 44% of unpaid principal remains from our Q1 2020 through Q1 2024 originations. Among the 56% of principal that has already been paid down, we've seen only 3% in net cumulative losses. For life of loan losses on this entire cohort of loans to reach 8% net cumulative losses, the remaining unpaid principal would need to charge off at a rate of 11%. Past vintages have performed meaningfully better after this point in the seasoning curve, further improving our confidence in achieving loss rates below 8%. Now turning to our fair value marks and key assumptions. Our personal loans are marked at 104.3%, 5 basis points higher quarter over quarter, with a negligible change in the discount rate. For our student loan portfolio, the fair value mark decreased by 17 basis points to 103.6%, while the discount rate rose by 10 basis points to 4.44% due to rising rates and a wider spread. Overall, sequential changes in spreads and discount rates had a negative impact on reported revenue. Moving on to financial services, where net revenue of $176 million increased 80% year over year, with new all-time high revenue for SoFi Money and our loan platform business, as well as continued contributions from SoFi Invest and credit card. Overall monetization continues to improve, with annualized revenue per product of $64, up nearly 29% year over year versus $50 in Q2 2023. This is driven by higher deposits and member spending levels in SoFi Money, greater assets under management and monetizable features in SoFi Invest, and robust growth within SoFi credit card spend. Net interest income of $139 million increased 87% year-over-year, which was primarily driven by growth in consumer deposits. Importantly, non-interest income grew 58% to $37 million in the quarter, which represents approximately $150 million in annualized revenue. This was driven by interchange growth of 67% year-over-year as a result of over $10 billion in total annualized spend, as well as our referrals from our loan platform business, which grew 66% versus the prior year period. Contribution profit reached $55 million at a 31% margin for the quarter, even as we continue to invest in innovation and new opportunities to rapidly grow this operating segment with attractive returns. Lastly, we reached 11 million financial services products in the quarter, which is up 39% year-over-year, with 865,000 new products in the quarter. We reached nearly 4.3 million products in SoFi Money, 2.3 million in SoFi Invest, and 3.9 million in Relay. Shifting to our tech platform segment, where we delivered net revenue of $95 million in the quarter, up 9% year-over-year and 1% sequentially. Revenue growth was driven by strong performance from new clients onboarded over the last 4 quarters, along with strong monetization of existing clients on our platform. Galileo accounts grew 23% year-over-year to 158 million. The segment delivered a contribution profit of $31 million, representing a 33% margin. We continue to leverage investments made in the segment as we continue to position tech platform for higher rates of diversified, durable growth going forward. As mentioned earlier, a strong pipeline of interest spans financial institutions along with major consumer and commercial brands, representing larger and more durable revenue opportunities and with longer sales and integration cycles due to the size and complexity. Shifting to our balance sheet, where we remain very well capitalized. Assets grew by $1.3 billion as a result of $2.1 billion of growth in loans and approximately $800 million decrease in cash equivalents, and investment securities. On the liability side, member deposits grew by $2.2 billion to $21 billion, while overall deposits increased to $23 billion. We also reduced our brokered deposits by $800 million as we continue to use our consumer deposits to replace higher cost parts of the funding stack, and we exited the quarter with $1.1 billion of warehouse debt drawn. Currently, there's a 213 basis point difference between the interest we pay on deposits and the interest we pay on warehouse lines, which translates to about $500 million in annualized interest expense savings, given the size of our deposit base. This difference also continues to support our net interest margin, underscoring the benefits of having the option of holding loans on balance sheet when advantageous and collecting net interest income. Overall, we expect to maintain a healthy net interest margin above 5% for the foreseeable future and benefit from the continued mix toward deposit funding, along with our ability to sustain healthy deposit versus lending betas. In terms of our regulatory capital ratios, our total capital ratio of 16.8% decreased by approximately 50 basis points from 17.3% last quarter and remains comfortably above the regulatory minimum of 10.5%. Lastly, we grew book value to $5.9 billion and tangible book value by $92 million sequentially to $4.2 billion, with tangible book value per share at $3.92. Now on to guidance. Throughout the last 12 months, we have demonstrated the benefit of having a diversified, high-growth set of revenue streams, multiple cost-efficient sources of capital, a keen focus on underwriting high-quality credit, and a high degree of operating leverage as we scale the business. We expect those benefits to persist even in light of the macro backdrop. For Q3, we expect to deliver adjusted net revenue of $625 to $645 million, adjusted EBITDA of $160 to $165 million, GAAP net income of $40 to $45 million, and EPS of 4 cents per share. For the full year 2024, we now expect to deliver adjusted net revenue of $2.425 to $2.465 billion, which is $35 million higher than our prior guidance range of $2.39 to $2.43 billion. This implies 17 to 19% annual growth versus 15% to 17% previously. This guidance now assumes lending revenue will be at least 95% of 2023 levels, financial services will grow more than 80% year over year, and tech platform will grow mid to upper teens % year over year. While this is lower than our original 20% guidance for tech platform, we view this as transitory and still feel confident in our multi-year growth guidance for this business. We now expect to deliver adjusted EBITDA of $605 to $615 million, above our prior guidance of $590 to $600 million. This represents a 25% adjusted EBITDA margin. We now expect full-year GAAP net income of $175 to $185 million, above prior guidance of $165 to $175 million, and GAAP EPS of 9 to 10 cents per share, above prior guidance of 8 to 9 cents per share. We continue to expect growth in tangible book value of approximately $800 million to $1 billion and continue to expect to end the year with a total capital ratio north of 16%. We continue to expect to add at least 2.3 million new members in 2024, which represents 30% growth. Overall, we couldn't be more proud of our Q2 results. Having delivered $597 million of adjusted net revenue and $138 million of adjusted EBITDA, we continue to make great progress against our long-term growth objectives and remain very well capitalized to continue to pursue our ultimate goal of making SoFi a top financial institution. With that, let's begin the Q&A.
All right, here we go.
At this time, I would like to remind everyone that in order to ask a question, please press star followed by the number 1 on your telephone keypad. Please keep in mind we'll take only one question per person at a time. Please rejoin the queue for any additional questions. And the first question comes from John Hecht from Jefferies. John, your line is open. Please go ahead.
Morning, guys, and thanks for taking my questions, and appreciate all the incremental disclosure in the deck. The question is, I think you said that cumulative losses would have to go above 10%, I think to 11%, for you to kind of breach your 8% assumptions in your underwriting. What kind of scenario would that entail, in terms of like payment rates or delinquency rates, and just to kind of connect the dots there?
Yeah, sure, John. Thanks for the question. So like we said, credit's performing in line with expectations, and we remain extremely confident in our 7 to 8% life of loan loss assumption. Just to reiterate what I had mentioned in my prepared remarks, when looking at all originations from 2020 through Q1 of 2024, only 44% of those remain. Of the 56% that got paid down, we've experienced only 3% net cumulative losses. So in order to reach 8% cumulative losses on the entire pool, the remaining 44% would need to charge off at 11%. So from where I sit, something would have to materially change in order to hit 8%, as prior vintages with similar levels of remaining UPB have never experienced losses even close to 11%. In addition to that, we ended up showing you vintage analyses that highlight how recent vintages, since making our credit cuts back in the second half of 2022, are performing materially better than the 2017 cohort, which was the last one to come even close to 8%. Furthermore, what gives us even more confidence is that the leading indicator for losses, which are our delinquencies, have started to turn the corner, and we're really bending the curve. So in our personal loans business, we ended up surpassing a peak in Q1 on not only dollar principal, but also cumulative fair value adjustments and percentage UPB. So from a dollar principal perspective, we ended up having $96 million of 90 to 120-day delinquencies in the quarter versus 103 back in Q1. From a percentage UPB basis, those were at 64 basis points in the quarter versus 72 basis points in Q1. And then from a cumulative fair value adjustment basis, that was $79 million in Q2 versus $88 million in Q1. And what's even more important than that, these trends are continuing throughout the first several weeks of Q3.
The next question comes from Terry Ma from Barclays. Terry, your line is open. Please go ahead.
Hi, thank you. Good morning.
So you show some pretty encouraging vintage charge-off metrics in slides 8 and 9, and it sounds like from your commentary, everything's kind of in line. But maybe just kind of reconcile your more conservative stance and maybe talk about what you need to see in the environment to maybe just grow a little bit again in the portfolio.
Thank you for the question. We're really encouraged by the trends we're seeing in credit, as Kris mentioned. We're really proud of the fact that we're able to achieve record revenue with 22% year-over-year growth, with lending barely growing. I would say the areas of incremental opportunity as we go into the back half of the year: home loans, really proud to see the growth rate year-over-year in home loans. Student loan refinancing, also a product that shouldn't be doing really well in this interest rate environment, also had strong growth. On the personal loan side, we're going to stay relatively conservative compared to our balance sheet ending assets there, primarily because we want to see how the year trends in terms of unemployment. There's a big number coming out on Friday. We're at 4.1%. A move to 4.2% could signal a recession. And so while there have been improvements, we're not changing our stance. We're able to achieve pretty strong growth year-over-year without getting too aggressive on the personal loan side. There are factors that could cause us to originate a lot more in personal loans. I will tell you, I see more near-term opportunity in home loans and student loan refinancing. But in personal loans, the thing that would cause us to be more aggressive in terms of the growth rate is if we have greater than expected sales. In addition to that, changes in benchmark rates. In addition to that, continued improvement in our credit trends if they start to accelerate better than we've already seen, which is quite positive. But all in all, we have a lot more growth. We could grow much faster if we wanted to, but we want to drive durable, diversified growth. And that was the reason why we took a stance in limiting our personal loan balances specifically. The other thing that could drive growth, which would be further diversification of the balance sheet, is home equity loans. We're now doing home equity loans as a principal as opposed to an agent. They're obviously secured lending and attractive rates, more attractive than personal loan rates. So there'll be a great emphasis on that. That could also drive better performance there. So a lot of opportunities as it relates to the lending business. We're taking a pretty conservative view purposely. I quite frankly don't feel like we're getting paid for the results we're delivering, so I'm not sure why we'd be overly aggressive at this point.
The next question is from Dan Dolev at Mizuho. Dan, please go ahead. Your line is open.
Hey guys, great results here. Really appreciate letting us asking a question. So, how are you, Anthony, Kris, how do you expect to keep growing financial services? I mean, obviously you've grown deposits so much. How do you expect to grow it given that you've grown interest income now? If you can talk a little bit about the near-term future. Thank you.
Thanks, Dan. Well, first, we did a really incredible job driving the diversification. The only way we're able to achieve record revenue is because our financial services segment had a record at $176 million, up 80% year-over-year. It was driven by product growth, as you know, up 47%. It was also driven by deposits, up 80%. That drives the net interest income. I think more interestingly is the growth opportunity we have in non-net interest income. We reported $37 million in that line item. It grew very nicely, 58% year-over-year. If you annualize the number, it's about $150 million. And there's a couple of drivers of that. First, continue to drive increased product growth. We had 47% growth in financial services products. That will be one driver of strong growth. The second is increased monetization or revenue per product. We saw strong growth in revenue per product in the mid-20s as well. What drives it going forward from here? Interchange was up 67% year-over-year. AUM was up 58% year-over-year. We'll see benefits in brokerage, not just from AUM growth, but also increased monetization per dollar of AUM, which is about half what we think the benchmark rate is. Continue driving home, auto, and life insurance, which we call SoFi Protect, and then our loan platform business. So it's a combination of those different monetization vehicles that will drive continued revenue per product, which we think has a significant upside after growing 29% already in this quarter. And then our product growth is something that's probably a lot more visible to everyone, which is up 47%. So dual-pronged growth dual-pronged dimensions of growth should continue to drive increased diversification there.
The next question comes from Kyle Peterson from Needham & Company. Kyle, your line is open. Please go ahead.
Great. Thanks, guys. Good morning. Thanks for taking the questions. Wanted to touch on deposits. Obviously, continue to see nice growth within the core base here. with members. But how should we think about the growth outlook for deposits and kind of how that counterbalances with any ongoing runoff of some of the brokered funding?
Yeah, I'll let Kris talk about the sort of specific trends in the quarter. But as it relates to the broader macro picture, we're obviously entering an environment where rates are likely to go down in the future. And many people ask us, will you maintain a high rate? And the answer is we will maintain a high rate relative to our competition. We think we have a competitive advantage, given that we have such a big origination platform. The origination platform allows us to fund a higher APY than a lot of other competitors that don't have an origination platform. So the two businesses work in tandem. As rates go down, the value of our loans generally go up, all else equal. And so we can maintain a superior APY. That doesn't mean we may not change it. It just means it will be superior to drive our differentiated value proposition and leverage our competitive advantage. As it relates to deposits, more specifically, rate is one element of our differentiation. The other elements of differentiation start with no fees. We do not charge. We don't require minimum balances to get our services. You do get a higher APY if you do direct deposit or you do a average monthly deposit of a certain amount. As we mentioned in the call, we'll actually launch SoFi Plus, which will give you that higher rate for a fee per month, which will be quite attractive relative to the amount of interest you could gain when you pay that fee. In addition to that, we have the ability to do person-to-person payments to an email address or a phone number. We recently launched Zelle, which is very unique among the fintechs, which is a highly requested product. In addition to that, we provide seamless capabilities into our brokerage business and money movement more broadly. So the APY is one important element of driving deposits, but it's the broader value proposition that we offer that we think will continue to allow us to drive strong deposit growth on the back of strong member growth in money.
Yeah, and what I would add to that is we've consistently said that we are going to add over $2 billion of member deposits each quarter. We certainly did that in Q1. We did it again in Q2 with $2.2 billion of net new deposits from a member perspective. We did pay down about $800 million of brokered CDs as they had higher costs relative to our member deposits. Right now, we are about just north of 80% deposit funded. Going forward, we believe the optimal mix is consistent with our prior guidance at about 80 to 90%. We still have about $1.1 billion of warehouse debt that's outstanding and nearly $2 billion of brokered deposits. So we're going to continue to optimize funding sources and lower our overall costs.
The next question comes from Reggie Smith from JP Morgan. Reggie, please go ahead. Your line is open.
Hey, good morning, and thanks for taking the question. I appreciate the disclosure on the loss curves, and I hope you guys continue to publish that. Kind of similar thing. I was curious, and I think I asked about this last quarter, about the credit card program or business. And I look at, the fact that you've got 4 million money users and, almost 4 million relay users, and only, less than 300,000 credit card accounts. And it would seem that there's an opportunity to really be very targeted and slice and find really prime credits within your customer base. Can you talk a little bit about that? Maybe, am I oversimplifying that? It just seems like that business could be a lot bigger than it is. But maybe I just don't understand how that ramps up. So maybe a little color on how that business grows and some of the things to keep it from growing faster than it would appear to have the opportunity to grow.
Reggie, thank you for the question on credit card. I would start by saying, we have a pretty diversified portfolio of products. Our goal is to drive a series of S-curves of growth across the products so that we drive strong, durable, diversified compounding growth for years, which means we'll invest in some businesses faster and quicker than others. I often say internally, we have some startup businesses, we have some Series A businesses, some late-stage growth businesses, and some mature growth businesses. Credit card is one of those early-stage businesses where we want to make sure that we get the marketing, the product market fit correct, the credit correct, and really the overall unit economics of our credit card on a per-account basis correct. We've spent the last 18 months working our butt on that, and we feel like we have the right formula. I know we have the right team. We did change the team about a year and a half ago, bringing in someone that's actually built this business from scratch before, in addition to running businesses. So we have a very positive long-term outlook for credit card and want to contribute to our business. I often say businesses like credit card and brokerage by themselves someday could be bigger than SoFi is in total today. There are companies that are very big that are just in the credit card business and just in the brokerage business. Today, those are small for us and we're investing aggressively. We pointed out the fact that the brokerage business and the credit card business combined are annualizing a loss of $100 million. So what are the changes we're making in credit cards specifically? We'll launch 2 new cards. We'll be testing them slowly. One is an everyday card where people get a much higher percentage reward on categories like food or things that are used every day. The second card is more of a no frills, no surprises card for people that are in our ecosystem that are members, but they have thin credit files, not because they have low credit, they just have very little credit because they may be a new professional, in addition to our existing card. Not only will we launch 2 more cards, but we'll make those cards work better with our other products. So if you're a SoFi Plus member, your rewards will be boosted because of that relationship between SoFi Plus and credit card. So we can start to benefit from not just targeting our members, but giving our members more value for using more than one product. And you'll see us continue to do that over time. But in credit card today, we're going to continue to move relatively slowly and not step on the gas too hard, because this is a business you can lose a lot of money and you can lose it every day. It's unlike a loan where you give somebody a fixed amount. In credit card, you have lines that are quite big and they can be utilized in nefarious ways and drive really high losses. So we'll continue to make sure we approach this prudently, but we are stepping on the gas a little bit more than we have in the past.
The next question comes from Jeff Adelson from Morgan Stanley. Jeff, your line is open. Please go ahead.
Hey guys, thanks for taking my questions this morning. I just wanted to circle back on the lending growth. I know you're still sort of maintaining a more cautious stance on origination there. You did a little bit better than we thought on originations this quarter, and your lending revenue growth looks like it's still up 5% year over year. So I guess just, are you seeing better opportunities coming in the door, and does it have anything maybe to do with more certainty around the forward look with rate cuts? I know you're talking about potential increase in unemployment rate from here as well. So just trying to square all of that. And then Kris, also just in terms of, the bending of the curve comments on credit, just wondering when you think that might translate into the, all in 5.4% charge-off rate starting to come in lower each quarter as well. Thanks, guys.
So in the lending business overall, our first objective is to make sure we continue to diversify the lending business relative to the total company. Less capital, less risky businesses get valued much higher. And we don't want to have an over-dependence on a high capital, high risk business. And this year, the macroeconomic environment accelerated our diversification, and it's worked out quite well. We also want to diversify within lending. As I mentioned, home equity loans is diversification into secured lending, which will be our second secured product. In addition to that, student loan refinancing is our oldest and used to be biggest product. We think is starting to come into a period where it can do quite well. And that's also diversification relative to unsecured personal loans. And then across home loan refinancing is also a vehicle. As we go through the year, I think it's important just to understand we're trying to manage to the overall growth of the company. We have so much resources we want to allocate, and we're allocating it to drive that outcome of diversified, less risky, less capital intensive businesses. If we wanted to grow personal loans more, we'd have to allocate more capital to it. Why? We have to drive marketing that drives the top of the funnel that then drives conversion. Those loans don't just happen because we decide to actually underwrite more. We actually have to spend money to underwrite more. Right now, we're choosing to spend that money in different areas that don't drive as much revenue. But despite that trade-off, we're still driving 22% year-over-year revenue growth and a record despite barely growing personal loans. So it's a very conscious effort to diversify in a number of different ways. Diversification means you reallocate resources other places. If we reallocated to personal loans, we would not achieve our diversification. Now, what happened in the quarter? Our marketing costs were more efficient. The money we were spending was driving more demand than otherwise would have demanded or otherwise would have driven, and we took advantage of the higher unit economics to drive more volume against a set amount of resources in that area. We could be more aggressive if we choose to allocate more resources to lending. That could happen because we have upside in other businesses. That could happen because the marketing efficiency is greater than we anticipated, or the credit is performing better, or we sell more loans. And so it's not because the growth isn't there, it's how we're choosing to allocate the capital in this environment relative to our broader goals. And I'll let Kris talk about the specific question you had on the losses.
Yeah, and in terms of when some of these early DQ trends will start to show up in the NCOs, we're sticking with our overall guidance of being confident in the 7 to 8% life of loan losses, and we aren't guiding to NCO rates specifically. Reason for that is quite simple. The NCO rate is very lumpy. It's a function of a number of different factors, such as originations in the period, sales in the period, and most importantly, the average age or how much UPB remains on the portfolio, which can be driven by a number of things. So overall, we feel really confident in our life of loan loss expectation of 7 to 8%, but we're not guiding to NCOs because they're so lumpy.
Final test question today comes from Peter Christensen from Citigroup. Peter, your line is open. Please go ahead.
Thank you. Thanks for the question here. Good morning. Nice trends. I was wondering if you could talk about the appetite for future asset sales, either demand for it, but also your risk transfer strategy kind of going forward from here, given that you are seeing improvements, credit improvements in your portfolio, particularly in the personal loan portfolio. Just how are you thinking about risk transfer from here, and if there's further opportunities to de-risk the portfolio? Thank you.
Yep, absolutely. So overall, we're seeing continued strong demand from credit buyers. We've done $3.3 billion in sales over the course of the last 3 quarters in our personal loan business and 4.7 in aggregate. That's predominantly driven by the shape of the interest rate curve with lower expectations in the second half of this year, as well as the next several years. So we have very attractive yielding assets with very strong credit profiles and low risk for buyers. Essentially, buyers are looking into locking purchases and programs ahead of any interest rate cuts. In addition to that, we have a really strong balance sheet. We are able to offer flexible deal structures to meet buyers where they need to be. We are one of the few participants that can sell in size. It allows investors to put money to work. It allows buyers to have one buyer versus many, and it allows them to have a long-term partner versus doing bespoke one-off transactions that require a ton of work. Buyers want stability of asset generation. So looking forward, we expect to see continued strong demand from credit buyers. In a declining rate environment, we would expect that demand only to increase as those buyers would have lower cost of leverage. And again, we're one of the few folks that have a sizable balance sheet who can do that.
We'll take one more question, operator, and then I'll close with comments.
The final question comes from Tim Switzer from Stifel. Tim, your line is open. Please go ahead.
Hey, good morning. Thank you for taking my question. How would a return to a lower rate environment kind of change the ROE math you guys have talked about on choosing to retain loans versus selling? Do you believe it could strengthen demand at all in the secondary market and kind of change your balance sheet management at all?
I would say generally lower rates are going to make the loans more attractive to those without origination platforms that have assets they need to deploy. Our weighted average coupon is quite high, and that ROE becomes more attractive as rate environment declines and there's less places for them to find that type of yield. We've seen that in the past be the case. So we would anticipate more demand. We'd have to manage it relative to our production and our own financial goals. But I do believe the demand would increase and the terms would be more favorable and the values also, would be attractive. We have to wait and see that happen, but that's what we've seen in the past. Great. In closing, I want to express my gratitude to our team. Q2 was the most rewarding quarter and dare I say the most fun that I've had in some time at SoFi. What made it special and fun was that we challenged ourselves to be better in areas that are the most difficult in the current environment, that aren't supposed to do well in this environment, such as home loans and student loan refinancing that had volume increases of 71% and 87% year over year. The team found a way to be better continuously throughout the entire quarter, not just each month or each week, but literally each day, finishing strong all the way through the tape when, quite frankly, the only reason was because we pushed ourselves to keep iterating. It was also fun because we made hard resource allocation decisions in 2023 that meant doing less than we wanted to in areas with great growth potential, such as invest and credit card, where we are now seeing promising results. Our invest business is accelerating with AUM up 58% on the back of a lot of hard work and only a couple of important areas, and a testament that less can be more. In our credit card business, the immediate gains from all of our iteration aren't so large today, but with time and scale, they will be massive and well worth the patience. If you can't tell by now, I feel great. To put it bluntly, I do not know of any financial services company or fintech that has transformed their business to be less risky, less capital intensive, while still driving strong revenue growth, 40+% user growth, all while massively increasing profitability and still funding a rapid pace of innovation. When you take a step back, it's inspiring to see. We hit record revenue of nearly $600 million with 22% year-over-year growth, despite lending barely growing. We did that because we achieved record revenue in our financial services segment at $176 million, up 80% year-over-year on the back of 47% year-over-year growth in products, 80% year-over-year growth in deposits, 58% year-over-year growth in AUM, and 67% year-over-year growth in interchange. In lending, we grew home loan volume 71% year-over-year, student loan refinancing volume 87% year-over-year, and personal loan volume 12% year-over-year, while delinquencies declined on an absolute and percentage basis for PL, and we provided vintage analysis that clearly shows why we are comfortable with personal loan, life of loan loss forecasts. And finally, we grew EBITDA 80% year-over-year. I love what we have built, but more than ever, I love the people we are building it with and the gritty culture we have created. Hard is not for everyone, but for me and those who stay at SoFi, it fits just fine. Thank you for your interest in SoFi, and talk to you next quarter.
This concludes today's call. Thank you very much for your attendance. You may now disconnect your line.
All right, we finally got some energy from Mr. Noto. As Jose says, this guy's talking in all caps. I didn't expect that last paragraph, but I think he kind of realized that it's his time to really start sounding like the CEO of a pretty amazing company, which is SoFi, that he is the CEO of. And not a bad call. At the end of it, he says, I feel great. This is the most fun I've had ever working in SoFi. I love what we have built and the gritty culture we've created. Hard is not for everyone, but for me and the people at SoFi, it works. And then reiterated their big numbers. Neil, thank you for being with me here today. What were your raw reactions to this call?
Yeah, I mean, to the reports, it was another good quarter, a great execution, triple beat. So I'm happy with that. In the call, I was looking for the deposit number. Then when we heard 2.2 billion, I was like, interesting. But apparently there was a one-time $800 million thing that happened. So that's the difference between the 1.4 and the 2.2 billion dollars. Okay, good. If they can continue to be above their own $2 billion a quarter goal, so that's great. He did sound extremely, extremely excited about the credit card business. We knew this was going to ramp up, but it seems like during this call, he was very, very focused with the message of the credit card business is going to be a pretty, pretty big one for us. We know from Robinhood that their credit card business is going to be quite well. I mean, the rollout is a bit slower than expected, but then again, there are some risk attached to credit card business if you're not doing it the correct way. So it makes sense that they're taking their time. Overall, good, positive, good vibes. At the end there, the CEO took a page out of Alex Karp's notebook, I think, when he made it clear to Wall Street that the company is doing everything well. And if you're not, let's be honest, if you're not trusting what they're doing, then just don't buy the stock. He probably also knows that there is a high short interest on SoFi, so probably going to try and burn those shorts along the way. But overall, good report. The stock, I don't know, it's up 2-3% only.
Yeah,
not surprised. Bad stock, not a bad company. But over the long run, if they can continue to execute, I think we're going to be quite happy. I do agree with you that Robinhood, when it comes to the consumer side of things, right, investing in all of that, they've got the best UI ever on the market. Makes it extremely, extremely easy to use their product. I don't know when Robinhood is reporting, but I'm pretty sure it's going to be quite a good report, a good quarter for them.
Yeah, I think so. Robinhood's going to report next Wednesday, and so we'll see what happens then. Overall, I thought this earnings call, and I was critiquing the previous earnings call in the beginning of the stream for just being boring. I definitely do not think this earnings call was boring. I was engaged. I was excited. Obviously, when they're just reading off the PowerPoint, that's a little boring. But in terms of the Q&A, the actual answers, the analysis, I thought it was good. I thought it made sense. I thought they hedged back against a lot of the short kind of bear case arguments that people usually make across SoFi. And the end of that call, obviously it was rehearsed, and Noto was probably reading off a script, but the inflection and intonation of his voice when talking about the culture at SoFi, why he says, he even at one point said, I don't think we're getting paid for the results that we're putting up, and the level of execution that they've had, which is, obviously better than most banks in terms of the speed of growth. I felt that energy. And now the question is, do the shorts feel that energy at 755? 759 right now in the pre-market? Does Wall Street feel that energy? Do people start finally putting a multiple that is differentiated from just the bank multiple? That I don't know if that happens just based off the energy. Because one thing that the energy was lacking was energy around this tech platform. There really was no clarity throughout the entire call around Galileo, Technisys, what's the growth around that. The analysts didn't even really ask about that, because I think at this point they've kind of just like wrote it off until you see any more growth. So what were your thoughts on that part of the business? And do you think that's what's needed to really get it to grow again?
Yeah, I mean, it's annoying. Another quarter, not much information about that side of the business. It is annoying because it's, I mean, not potentially, but it will be a pretty big part of SoFi's future. And yet we never really get that much information about that. I know deals take time. I know they're going after big enterprises, institutions, and stuff like that. But when you use, for example, the wording here, tech platform continues progress on its journey of becoming the AWS of financial services. When you use the AWS type of thing, give us a bit more during the earnings call. At least give us a bit more information. Why is it not growing that fast? What are the deal structures? Are there any deals right now in the pipeline? When do you think those deals will get done? These types of information. If you're hyping up one side of the thing, give us at least the other side. Give us more information. I mean, contribution-wise, it's doing okay, but I would have loved to get more information. Again, it's been quarter after quarter where there is lack of information with regards to that. Galileo has done quite well growth-wise for the quarter. Galileo accounts up 23%, which again, quarter over quarter is much better as well. So that's good. But again, for the whole tech platform thing, give us a bit more. Give us a bit more.
I would agree. And until we get more, I don't know if the street's really going to change the multiple on this. We'll talk about PayPal in a second. One more thing on SoFi. Anything in this deck that stood out to you, whether it was members or Galileo accounts or products, or overall pretty good to you?
No, overall pretty good. To be expected, let's say. I mean, my expectations for members were a bit lower, so that's good. Galileo, well, tech platform revenue I thought would come in a bit higher at 100 million, maybe a bit more, came in a bit lower. That's fine. Revenue a bit higher. No, overall good quarter. We did get 2 new slides, I think. Yeah, these ones.
Yeah, these ones.
Always good to get new slides. But no, overall good quarter. So that's about it. Good quarter, good execution. Of course, I do feel that this is a type of stock that will get a huge bump in price whenever we get that rate cut.
Yeah.
When will that happen? I don't know, but this is just my feeling. Although they're winning both ways right now as well.
Neil's YouTube is in the chat. Everyone, please make sure to check him out as well and subscribe if you're not subscribed. Neil, PayPal. I'll pull up the numbers, but what were your raw thoughts on this one?
Good quarter as well here. Again, execution is key. They've been executing quite well. The stock finally showing a little bit of life. But then again, last quarter we were up over $70. And yesterday we were under 60. So it's not like we haven't seen this story play out before. Good quarter, good execution. Now the thing is that they have to continue to execute. But overall, the company is actually growing, and it's growing in a much more profitable way. which will allow them to grow more aggressively eventually. I think that's the plan in the second half of this year. Haven't listened to the whole earnings call just yet, but that's the plan. They're buying back a lot of shares, expected to buy back $6 billion worth of shares, which was yesterday's market cap. When now with the recent increase a bit less, but yesterday was $60 billion in market cap, 10% of the business. So yeah, pretty good. If the market does not respect PayPal, they can continue to gobble up more and more of their own shares, and eventually the market will realize that they grow and they grow in a profitable way, and my shares will be worth more. So
yeah, I think at this point, if you own PayPal, I know we all like are annoyed at the stock action, but the quarter was phenomenal. They beat all their expectations. The numbers, EPS is up 34% year over year. Are you kidding me? Like they really executed, and they're buying back another $1 billion worth of stock. So if you own PayPal, eventually they're just going to buy out your shares and you'll get something. But the point is, the street is going to have to recognize the insane amount of money the company's putting back into the stock. And I think the troubled perception around Apple Pay or Cash App or whatever deteriorating from PayPal's quote unquote moat that would get the street to buy, that has to be dealt with at some point. I don't know what Alex Kris is going to do about that perception, but I think that perception is still an overhang on the broader stock. But the company is executing very well. So if that perception is not reality, even if it's being treated as reality, the stock's going to go much higher eventually. It's just might take a few years till it gets there.
Yeah, no, I agree. I mean, right now we're also previously Braintree, which was growing quite fast, but not as profitable for the business. For this quarter, they said here Braintree contribution to transaction margin dollar growth improved. Transaction margin dollar is going to improve more this year than previously expected. So things are going into the right direction. Yes, it's true that where is that number here? I think take rate.
Take rate is
still down. Still down a little bit. I do expect it to bottom out pretty soon. It's down, but down less than previously. So that's already, let's say, glass half full type of thing. But just like with active accounts, previously everybody was focused, active accounts are coming down, but they were focused more on quality than quantity. Eventually that bottomed out, and that now continues to grow quarter over quarter. Overall, they're doing quite well. New management, new CEO, completely new team, launching new products. And the fact that they can grow now and grow in a more profitable way than before makes me even more bullish, because we're yet to see really full effects of everything that they've been working on since Alex Kris came in. So yeah, the market will eventually notice the big change. When will that happen? I don't know, but we've seen V-shaped recoveries happen in the last 2 years or so. So yeah, patience is key. I'm not saying this is another Meta Facebook, because completely different company, completely different profitability profile, but when the market notices that PayPal is growing and is becoming extremely profitable and it's not dead, I think the fun will start.
So take rate is how much they make on the transaction revenues?
Yeah, so there's transaction take rate and then total take rate.
Okay, so total take rate is for every dollar that comes into the ecosystem, how much do they make off that essentially?
Yeah.
Gotcha.
Basically like a Visa MasterCard type of thing.
Got it. So yeah, that is down slightly, but the broader quarter I think was strong enough for the street to potentially overlook that one. In terms of the share buyback, so they're doing another $1 billion of share buyback, so that would be $6 billion. Over the past 12 months, they returned $5 billion by buying 82 million shares of the float, and they bought 24 million in the past 3 months. It kind of makes you think, where would PayPal be, the stock, if they didn't buy these 24 million shares of stock? You know, like, will we be in the 45-ish? Because, I mean, that would be kind of insane. But they are buying. I mean, this looks like a candidate for Warren Buffett, quite frankly. It looks like something an institutional manager needs to come into and take a stake in, but not sure if that would happen.
Yeah, or, I mean, I think we talked about that quarter ago or two. Or take it private, because eventually you'll be like, okay, if nobody wants to buy this thing, we're just going to buy back the whole company, put it privately, and that's about it. But yeah, could be a good candidate, although I don't think Buffett makes lots of decisions these days. But
yeah.
One
thing about Buffett, guys, is he just sold 29 million shares of Bank of America. So, or not 29 million, I think $792 million worth of it. So he is continuing to sell. He sold $3 billion in the past week after Bank of America's earnings. Yeah, today he sold 767 million of B of A. So we are seeing people, along with Zucks and Jensen, take their profits. So you kind of got to do that information what you will. But Buffett is taking profits on Bank of America, and he took some profits on Apple a couple months ago as well.
Yeah, I mean, makes sense. I mean, he still gets millions from the dividends from all of his companies. So
Right.
highly doubt he's hurting that much. But yeah, no, I think, and we'll also see institutional investors. I think one comment here said Terry Smith. I do believe Terry Smith had a position in PayPal, took a position in PayPal. I think we're going to see maybe more institutional buyers buying to PayPal if things continue like this. Just my opinion.
Now, so Neil, last question for you, then I know you can get out of here and I'll get into the broader market open. Do you think that the stocks hold up today? PayPal 7%, SoFi 3%. Do you think they tank on earnings or not on in the market open because JPOW speaking tomorrow and there's a little bit of fear about that? Or do you think they can hold from these numbers?
Because you're going to eat mayonnaise tomorrow?
Only if he raises the rates. Only if he raises the rates.
No, I think it holds. I think it holds. If it were another company like last week, or it was last week, with Alphabet, we were green and then suddenly red. Different profile. I think these two stocks have been hit quite a lot. I know SoFi is up a bit in the last week or two, but I think it can hold. Will it hold the whole? I know PayPal is up 7% right now. We've seen crazier things, right? Pre-markets up 7% and suddenly down only up 2%, or it can go up 10%. Depends on what the market is feeling here. Is this sentiment completely changed? But overall, I think they'll keep their gains, at least for today. And then tomorrow, if Jerome Powell says something positive, then suddenly the sentiment might change towards these two companies. Plus, there is a lot of earnings today, tomorrow, the day after that. That will definitely impact the market. Huge companies reporting.
Yeah, so I have a SoFi position of around 70 calls that are in the money. They're up, and I am thinking when to exit them. I don't feel this is a quarter that warrants selling them because, like, you're worried about the stock necessarily tanking. It still could, but I don't think this quarter showed any signs of that. And number two, I agree with Sachin right here. I think rate cuts and the confirmation of rate cuts by Jay Powell tomorrow, basically the way he talks about it, I think that's still going to be bullish for SoFi and PayPal. So PayPal, I do think holds because PayPal went to 75 last time, then it collapsed all the way down. And so maybe it like at least maintains the 64, 65 level. But SoFi, I feel like you got to give the market the time to cut to really see what happens to SoFi. And it's a little premature getting out. Now, if it pumps to $9 today, then yeah, that's probably you take some profits there. Yeah. But if it stays stuck in the 750 range or 720 back down to 705, I don't know. I think the rate cuts ultimately are a catalyst.
Yeah, no, I agree. I mean, they even said that they can keep their rates, their yields higher for longer. SoFi, right. That is not the Fed. But yeah, we'll see. Definitely SoFi a bit trickier than PayPal right now.
Right. All right, Neil, thank you for joining. Someone said you speak in lowercase italic.
Yeah, I don't know what that means, but okay. It's maybe fancy, maybe.
No, but I get it. You kind of like when you talk, it's so relaxed and calm, but there's a little bit of an accent on it. So it's like lowercase.
Okay, that's good. That's good. Maybe I'll have to talk a bit more with my hands. Maybe people will think even more that I'm Arnie's brother.
Yeah, they're gonna think you're Arnie. Yeah.
I am looking to buy a new couch. I know.
Is that a couch you've been sitting on?
No, it's a very uncomfortable office chair. I need a gaming one, but I definitely need a new couch as well. So hopefully PayPal and SoFi will do better this year, and I can buy a very nice one.
Okay, Neil's YouTube is in the chat. Real quick before you leave, Neil, why do you call yourself Couch Investor? I don't think I've ever asked you this question.
Because I started the channel. It comes from Couch Potato. It was during the pandemic. Everybody was basically watching Netflix. So I kind of Couch Potato, Couch Investor. I love investing. Let's mix the two. Boom, Couch Investor. That's basically that. Laid back investor, even though not really laid back anymore since we're all freaks of the stock market. But yeah, Couch Investor, I don't know. Sounded great. Plus, it's a great conversational starter.
So it wasn't like Casting Couch or anything like that?
Depends who asked.
I love it. Thank you for joining, man. Everyone, if you aren't subscribed, please make sure to subscribe to Neil. We'll see you next time, Neil. Thank you.
Thank you. Bye-bye.
Bye. All right, folks. So we had SoFi. We had PayPal. It is time to get into the broader rest of the market open. Thank you all for being here this morning. Again, quick recap, SoFi and PayPal, good earnings. They both crushed it. SoFi stock up 2.86%. Noto had energy. He had confidence. He had chutzpah. I don't know if I'm using that word correctly, but he had the energy you needed to feel like he was the CEO of a multi-billion-dollar company that was executing flawlessly. And although there are some issues here and there within the broader business, they are executing at a high level better than a lot of other banks. Obviously, they're a much smaller company, but they're doing what they need to do. And I felt that energy in this call. PayPal up 7.19%. PayPal beat on transaction margins, beat on revenue, beat on EPS by 34%. I mean, really, they crushed. They're buying back another $1 billion worth of stock. If you're looking for a name that's potentially a value trap, but also I think has more of a probability of just being a broken stock, not a broken company, and not a value trap over the next 5 years, I think it is PayPal. I mean, it's just becoming very obvious that they're executing at a high level along with being friendly to shareholders with all the buybacks. Will the market perception change from like the lack of a moat and Apple Pay killing it? I don't know. Maybe not in the next coming months or even next year. But eventually, I think if PayPal is not a broken business, which is not, that perception will change and PayPal will get the benefit of more increased momentum. So we'll see. We'll see what happens. The Jewish slang would be moxie. Okay. Why did I say chutzpah? I don't know. I heard that on a TV show one day, so I said chutzpah. But Noto had the energy. That energy was important. Alex, I haven't heard the earnings call. We'll listen to that later. But the overall quarter, I think, will be respected by the street eventually, even if it's not right now. So that's what we have for SoFi and PayPal, and we'll see what happens with them in 11 minutes. Let's look at a couple of clips yesterday from the Jensen and Zuck's meeting. I thought this was pretty fun of a meeting, and it actually gives some insights into what's happening with Meta and Nvidia. So let's first play a fun clip from the call where Zuck talks about how much damn money he's spending with Nvidia.
You still call it Hopper H100, but so you guys know when Zuck calls it H100, his data center of H100s, there's like, I think you're coming up on 600,000, and we're good customers. That's how you get the Jensen Q&A at SIGGRAPH. Wow. Hang on, I was getting the Mark Zuckerberg Q&A. You were my guest, and I wanted to make sure that you just called me one day and you're like, hey, in like a couple of weeks we're doing this thing at SIGGRAPH. I'm like, yeah, I don't think I'm doing anything that day. I'll fly to Denver. It sounds fun. Exactly. I'm not doing anything that afternoon. You just showed up.
Jensen called Zuck and was like, hey, you spent $24 billion in the past year on our product. Do you want to come talk to me about why you spent all that money? So it really it's just so wholesome to see two billionaires casually talk about, the amount of money they're spending. But the broader point in this sort of 2-hour Q&A that they did panel was that Zuck is spending a lot of money on Nvidia. And the reason he's spending a lot of money is because he believes that GPUs are going to be essential to creating the AI revolution that Meta needs in order to truly change the trajectory, not only of social media, but of content in general. Here's another clip where I thought what he said was really interesting and why specifically you need NVIDIA GPUs. For anyone who's concerned, why do we need GPUs? This clip kind of gives you clarity around how much content Facebook has and how those GPUs actually enhance the recommendation engines.
Now, over the last few years, it's gotten to a point where more of that stuff is just different public content that's out there. The recommendation systems are super important because now instead of just a few hundred or thousand potential candidate posts from friends, there's millions of pieces of content, and that turns into like a really interesting recommendation problem. And with generative AI, I think we're going to quickly move into this zone where not only is the majority of the content that you see today on Instagram just recommended to you from kind of stuff that's out there in the world that matches your interests, whether or not you follow the people. I think in the future, a lot of this stuff is going to be created with these tools too. Some of that is going to be creators using the tools to create new content. Some of it, I think, eventually is going to be content that's either created on the fly for you, or kind of pulled together and synthesized through different things that are out there. So I think that's just one example of how kind of the core part of what we're doing is just going to evolve, and it's been evolving for 20 years already.
So this part was really interesting to me as well. I got one more clip that I want to show, but on this particular clip, Jensen Zucks is basically saying, hey, we have so much content to recommend. And essentially what is social media, right? It's a feed. There's millions of candidates that get to get into that feed, and you're scrolling that feed and you're trying to optimize the feed for the user in the way that the best content pops up on their feed so that they stay engaged, they look at ads, etc. So content creators are posting the content. Zucks has this massive, multi-trillion-dollar problem, which is, hey, I have all these pieces of content. I need to give creators the exposure they're looking for, and I need to get consumers in front of the right content. What if AI could just make the content one day, right? What if, like, if I care about basketball and LeBron just like made a dunk, instead of just showing you the video of the dunk, I have this like AI generated animation sequence of the dunk, which is more engaging than just the dunk itself, right? Like, there's a variety of different ways that I think content can grab our attention. And if AI is the basis for the creation of that content, like the news in AI and all these different formats, maybe that's even more profitable for Facebook, the advertising even better, but also it just keeps people on these platforms and more excited to see the content coming from those platforms. So I think there's going to be a variety of use cases. For those that are wondering, why does Zucks own 600,000 H100s? It's because in order to recommend that content in a sophisticated way that makes the advertising targeting better, this is what Google talked about on their earnings as well, you need the GPUs. This is AI. Now, this is not AI that's creating like hundreds and hundreds of billions for Google and Facebook yet. There's different use cases for that over the coming years that they're working on. But in terms of their core businesses, which is advertising, AI is making the targeting better, the recommendations better, and you need the GPUs to be able to do that. And you probably want to overspend on GPUs because you don't know what other use cases could come from that, which is why when Zucks started going down this whole metaverse lane, he was able to pivot into AI because he had all the GPUs. So that is one thing that kind of shows why Nvidia is important. And again, Zucks just keeps buying more GPUs. It does seem like Nvidia is going to beat estimates again going into the quarter two. Last clip of Zucks talking about the glasses and why they why they're investing in glasses and what it means for the broader appeal of style, and also his PR transformation as a style influencer.
When everyone kind of went remote for a bit, it's like you're spending all this time on Zoom. It's like, okay, this is it's great that we have this, but in the future, we're like not that many years away from being able to have a virtual meeting where, like, it's like I'm not here physically, it's just my hologram. And like it just feels like we're there and we're physically present. We can work on something and collaborate on something together. But I think this is going to be especially important with AI.
Application, I could live with a device that I'm not wearing all the time.
Oh yeah, but I think we're going to get to the point where it actually is.
Yeah, I could.
It'll be. I mean, there's within glasses, there's like thinner frames and there's thicker frames and there's like all these styles. But so I think we're a while away from having full holographic glasses in the form factor of your glasses. But I think having it in a pair of stylish, kind of chunkier frame glasses is not that far off.
These sunglasses are the face size these days. I could see that.
Yeah, and you know what? That's that's a very helpful style trend.
Yeah, exactly. That's a very helpful.
So whoever
style
it's like I'm trying to I'm trying to like make my
exactly.
way into becoming like a style influencer, so I can like influence this before before the glasses come to the market. But
well, I could see you attempting it. How's your style influencing working out for you?
It's early.
Yeah,
it's early. It's early. But I don't know. I feel like if a big part of the future of the business is going to be building kind of stylish glasses that people wear, this is something I should probably start paying a little more attention to.
That's right.
So again, Zuck's doing his PR transformation. I mean, again, it's a transformation that has to be studied over the next century in terms of what Zuckerberg has been able to do. He does not sound like the weird dude that he was in 2018. Now he sounds like he's trying to be a fashion icon. So overall, I thought the meeting was good between Zucks and Nvidia. And you saw a Zuckerberg that was very relaxed, very calm. Kind of feels like, I don't know if Q2 is going to be amazing or not, but he feels like he knows what he's doing when it comes to buying up all these GPUs and deploying them in a meaningful way. And then Jensen also realizing that we are getting a lot of spend from some of the hyperscalers, and I don't think that spend is going away anytime soon. We will watch SoFi on the open. We got the market open in 3 minutes. We'll see what happens to SoFi and PayPal. Now, another thing that's really important is today we have Microsoft after the bell, along with AMD and Starbucks. So today's going to be a very big one. PayPal's up 6.2%. SoFi right here up 3.4%. We'll see how these open in a couple minutes. Microsoft, AMD, Starbucks, and Pinterest are the big ones after the bell. We're going to see what happens to them. So I'll be live at 3:45. And Microsoft's really important. They've got to hit their Azure numbers. They're guiding for about 30% growth year over year on the cloud. They got to hit that. Copilot has to show more penetration of revenue. It doesn't have to show astronomical gains of revenue, but it does have to show that more Office 360 users, which there's about 365 million of them around the world, are opting for Microsoft. Even if you get 3 or 4% of them over the next 2 years to pay the extra $30 a month, you're talking about an additional 0.5% of revenue growth per year on Microsoft, which makes a really big difference. So for Microsoft, that's going to be important for Copilot and for cloud. And then for AMD, we need to make sure guidance is getting stronger because guidance over the past 2 quarters has not been that strong. So AMD and Microsoft are going to be the big ones that start off big tech and the semiconductors this week. On did really good yesterday. On down a little bit right now, is up 11.54% yesterday. And McDonald's, not the best earnings, but that one had its best day since 2020 because the stock was a little beat up before coming into earnings. Some other earnings we have in the morning. So Merck, they beat on revenue by 6% or by 1.2%, beat on EPS by 6%. Their stock currently is down 4%. Okay, so something must have been bad in the guidance. They beat on revenue by 1.72, EPS by 6.05. We have BP. They missed on revenue by 10.6%, beat on EPS by 8.7%. BP in the pre-market is flat, up 0.34%. So we'll see how that opens. And then Pfizer beat on revenue by 2%, beat on EPS by 30%. Pfizer is up about 1% in the pre-market. So nothing too crazy. Nothing too bad. CrowdStrike pre-market, yeah, we'll see how that opens. It's time to get this sucker to 200 to really go long, if not 180. Delta is hiring another lawsuit, which is why CrowdStrike is falling, but we'll see what happens as that one goes lower. 9:30, stock market is now open. All right, SoFi opens up 3.4%. There you go. There you go. SoFi is up. The stock market is now open. Wake your asses up, 3.5%. So SoFi opening strong. Nothing too crazy on SoFi. 7.64 now. We're up 4.2%. There you go. 7.68, 7.67. Let's see if it really catches a bit. Oh, there you go. 770. There you go. 770. Let's see if it can hold. Let's see if SoFi can hold this. 772. There's the bump. There's the bump. There is the bump. We're up 5%. If it makes a run to 8, that would be really fun. Let's see. 5.3%, 7.72. PayPal on the open. PayPal on the open is up 7.68, 63. 63.39 on PayPal. There you go. 63.39 on PayPal, up 7.2%. PayPal is holding. CrowdStrike dumping 6%. We'll talk more about CrowdStrike in a second, but they're dumping. Robin at 21.21. Tesla down slightly at 2.31. SoFi still 770, holding that 5%. Nvidia down 1.11. IWM small caps are up 0.5%. So small caps are up as well on the day. SoFi 777. 777 on SoFi. Look, it's not bad. It's green. Do you guys think it's red in the next 5 minutes? Do you think it's red in the next 5 minutes? What do you think? What do you think? What do you think? What do you think? 777. The bids are coming in. Let me look at the order flow. 780. There you go. 780 on SoFi. There's not a lot of resistance, to be honest. There's like 20,000 shares at 785. So 785 is going to be a little resistance, but no, there's not a ton of resistance. I don't think so. It doesn't seem like there is. Yeah, there you go. 785 on SoFi. Is it trying to go to 790? Is it going to try to go to 790? Let's see today, folks. SoFi's up 7%. Holy crap, 7.8. Now, again, will it hold is the broader question I think we're all going to be concerned about, because we've seen this happen last time. It pumped to 950, then dropped all the way down back to 7 that day. But market's giving it a bid. Market is giving it a bid. 787. We'll go back to SoFi in just a second. Let's look at some other stuff. Palantir Palantir got upgraded by Citibank to $28. I'll go through all the price targets in a little bit, but Palantir got another upgrade. Yesterday, they got upgraded from Jefferies to 28. Today, Citibank to 28 as well. So Palantir getting a host of upgrades. PayPal 63.89. PayPal up 8.3%. PayPal maintaining momentum. I mean, PayPal's doing its thing, keeping that 8%. BP is up 0.47. Pfizer's up 0.07%. McDonald's is up again a little bit. Robinhood 21.22. S&P 546. S&P is green. TFC is green, about to hit 45. Regionals are green. KRE is green. XLF Financial is green. AMD is green before earnings 140. Intel $30.84. That $31 covered call, it always does okay for Intel until they get out of this range. Rocket Lab at 534. Verizon at $40. Meta 469. Google 170. Hims 22. 3M 126 on the day. SoFi 782, up 7%. The big question now is, will SoFi hold these gains? Again, the quarter, I think, justifies these gains. The stock action historically ends up giving back these gains, so we'll see what happens. But SoFi right there at 786. IWM as well, up almost 1% on the day. CrowdStrike down 4.6%, and then PayPal up 8.75% right now. Benny says, if I own SoFi, I'd be selling right now. See, the thing about SoFi selling SoFi right now, SoFi 790, is that I think the rate cut is a tailwind. And maybe I'm wrong on this, but I think the stock gets momentum on the rate cut. And when we get the rate cut, I do think it's hard to deny SoFi's closer to $9 if everything else keeps up, versus, tanking to $6 to $5, because all banks are going to benefit. And even if it's just like overvalued at $9, but it moves with the tailwind of all banks starting to do well, because regionals in particular are going to do well, along with small caps, which SoFi is trading with small caps as well. I think the rate cut is something you wait for. Now taking profits here is not a horrible move if you bought in at $6, right? And you got the absolute bottom, 615. But I think the rate cut is going to be important. Okay, so that's what we got on SoFi. SoFi right here at 784. Let's see what happens. Again, the volume on SoFi so far on the day, 18 million. Wow, the average volume is 35 million. So it's done more than half of its volume in the first 5 minutes. And it's up 7%. That's not bad. PayPal still up 8%. PayPal holding their gains as well. $63 isn't crazy, but I mean, because it was there a month ago, it was at 75, but at least it's up from that $57 range. Again, PayPal buying back another $1 billion worth of stock, and that's why PayPal is getting some momentum. Now, CrowdStrike. So what happened with CrowdStrike yesterday is that Delta hired a big-ass law firm, and that law firm is going to sue the shit out of Microsoft and CrowdStrike, and they're assessing about $5.7 billion in damages across all of the clients that were affected by this IT outage. We will have a generational opportunity to go long on CrowdStrike at 180 to 200 if things get really bad. I think things can get really bad after the Q2 guidance, because they're going to have to revise the expectations and they're going to have to take a hit. There's no way they don't. So CrowdStrike's still the number one name. I think most customers are not going to leave, but they're going to have to pay back a lot of rebates to customers. So if we get a chance to go long at 200, that would be really exciting. But that's why CrowdStrike is down 5% right now. I said on Twitter yesterday that if CrowdStrike has some more gift cards, they can just give that out to the Delta people, and that might help alleviate the pain. But if the gift cards can't cover it, then yeah, they're going to be in litigation for the coming months. So that's what we have on CrowdStrike. ARM is up a little bit right now. AMD up slightly. Again, regionals are doing well. Big tech, let's go to the Mag 7. Tesla led the way yesterday, up 7%. Tesla today down 1.65. Nvidia's up slightly. Amazon 185. Google 172.66. So Google's up from that 168 level. Meta at 470. Microsoft at 427. Apple at 218 on the day. So not a lot of movement in big tech. Tesla's the only one that's down. Again, Tesla got 2 big upgrades yesterday. Crypto, Bitcoin, 66,000. That's up a little bit. CleanSpark's up 1%. Coinbase is up 1.2%. They have earnings on Friday. Iren is up a little bit. Cypher is up a little bit. Robinhood down, basically flat on the day, down 0.09%. And then Ethereum as well at 3,300 on the day. Disney, where's Disney? Disney stock 92.90. That's up about 1%. Palantir 27.32. SoFi now giving back some of the gains at 7.68. So you're seeing SoFi up 4.5%. At one point, it was closer to $8 at 7.90. So giving back some of the gains. We'll see if there's a reversal there later. But SoFi right here at 7.69 on the day. I mean, even if it closes above 7.50, 7.70, that would be not a bad day for earnings at all. Tilray's up 10%. Yes, this is the weed company. They had a decent earnings yesterday. So they're up 10%. They're down 95% over the past 5 years, but If you bought in the pre-markets yesterday or during the market yesterday, you were up 10% on that as well. What else do we have? So that's what we have in the context of Tilray. Again, we looked at earnings this morning. Not too bad in the context of other companies that reported. Palantir still 27.36, SoFi 7.69, and PayPal, wow, 9.4%. Street really starting to like the buybacks, I would imagine. Again, when you buy back another $1 billion worth of stock, you're going to start to see the Street at least take a broader look at you. BP, Pfizer, Merck all had earnings today as well. American Tower had earnings. They beat by revenue on EPS, or beat by EPS by 10%, beat by revenue at 2.84%. And those, JetBlue had earnings as well. Wow, JetBlue beat EPS by 172%. JetBlue, oh my God, it's up 11%. There you go. JetBlue beat EPS by 172%, 8 cents of a profit versus 11 cents expected. Revenue 1% beat 2.43 billion versus 2.4 billion. Not bad. There you go. JetBlue in line with the airlines, starting to do well, and not too bad. Is Tilray in the IWM? I'm actually not sure. I don't think so. I don't know if it's in the IWM, but it is definitely a small cap. Palantir 27.32, SoFi still 7.70. It's holding on to that 5% gain. It's not giving it back yet. So 5%, the shorts maybe covering a little bit right there. SoFi up 5%, IWM up 1%. The Russell, small caps doing okay. And PayPal up a cool 9.95%. It's going to be up 10% today. Not bad at all for PayPal. S&P is up slightly. Where's the NASDAQ? QQQ is slightly green. So IWM's leading the way with small caps. The NASDAQ and the S&P are relatively flattish up, but IWM is up, and that's why SoFi. Oh, SoFi just gave back some gains. Oh, there's the red candle. Wow. Just went from 5% to up 3%. So someone just dumped a ton of SoFi right there. So someone just took some profits. Palantir right here, 27.40, getting a little bit of momentum, up 1.14%. And then small caps breaking out 224 on IWM, which is not bad. Not bad at all. Amazon is news. What news on Amazon? What news on Amazon? Amazon right here at 184. Let me see if there's anything on Amazon. CrowdStrike getting really hit right now. Yeah, PayPal's up 10%. Amazon is expanding its 1 to 2 day delivery capabilities throughout the country as it seeks to boost sales in less populated regions and expand to the latest frontier of ultra-fast delivery in the United States. So it seems like they are continuing to grow. Amazon up almost 1% across the entire country with very fast delivery. Peter, thank you for the $20 super chat. I just found out the reason Trump was late to the Bitcoin conference was because Secret Service had to intervene due to a potential security threat, and they told him not to go on stage. Ah, interesting. Wow. So, yeah, I think Trump is trying to make a statement here that he's going on stage without, caring about... he doesn't want to seem weak after the attempted assassination, so that's why he continues to go on stage, and that's kind of just his personality. But it makes sense that that's why he probably felt a little off in his game if there was potentially a threat. Okay, SoFi is giving back all of its gains. SoFi is up 1.2%. So there you go. This is typical SoFi. There you go. So, it's about to go red. Oh, don't let it go red. Don't let it go red. No. Every time, dude. Oh my God. It's every time. Every time. I still think the rate cut is bullish, but goodness gracious, every fucking time, dude. This thing cannot catch a break. Now, granted, I don't think anyone should be surprised by this because we got JPow speaking tomorrow. So if JPow says good stuff, maybe SoFi actually keeps its 5% gain tomorrow. But JPow, I think the entire market, I'm surprised small caps are up with JPow speaking tomorrow because you would imagine they're more fearful of what he's going to say. But yeah, SoFi's about to go red, dude. Oh my God. SoFi, it's up 0.2% right now. Wow. Dude, it just went red for a second. It's 2 cents away from going red. Yeah, there you go. It's like fighting to stay green. I don't know what the company has to do to change this narrative, but I thought the earnings was good. Is this your first time? Oh my gosh. Well, there you go. Pump is gone. So if you sold within that pump, you had 2 minutes to sell, then congrats. If not, back to bag holding, baby. Noto's on CNBC. Okay, let me get him up. This is why I pay $73 a month for YouTube TV, for me to listen to Noto explain why the stock can never move. All right, here we go. Start from the beginning. We'll start from the beginning. Here we go. Let's hear Noto. Let's see what he has to say.
Which was Peloton, which is, by the way, better than Peloton.
One bright spot was Guinness, I believe. They did
Beer is still selling really well,
growth, and it's
but SoFi second quarter results were out this morning, and we're going to find out from Anthony Noto, who's the CEO, that the numbers are really great. We want to see if the stock will react to it because it's not reacted to the last two times that they had good numbers. Anthony Noto, welcome back to the show. How are you doing?
Doing great, Jim. Thank you for having me. How do you and David?
Yeah, I've got David here too. All right, so Anthony, explain to me how you can have such extraordinary numbers, and why do you think that the market's not reacting to the fact that you're 40% now, like more of a software product that's absolutely terrific? You have a declining number of charge-offs, which is really amazing at this point in the cycle. You've got people, a huge number of people have signed up. When will people realize that you're going to have a breakout of tremendous proportions and go ahead of it? Or do they have to see the real breakout before they realize, holy cow, why didn't I buy that stuff?
Yeah, I think this quarter is definitely a milestone quarter. When people sit back and do the work, they'll realize the magnitude of the transition we made. We had record revenue, as you know, almost $600 million, up 22% year over year. That would have never happened without us driving diversification outside of lending, which only grew 5%. The financial services sector grew 80% year over year. And it's driven by both 40+% product growth and 29% growth in revenue per product, both of which will continue to propel the growth of the overall company. So we've made a transition from risky, capital-intensive lending business to higher return, less capital, less risk financial services business. That's been happening throughout the year. And without the scale that we've achieved this quarter, we'd have never gotten to another quarter of record revenue and really strong improvement in profits and some good underlying trends, as you mentioned, in lending, which is optionality on rates coming back down. I think in terms of the stock, I think it's just a question of where rates going, where the economy is going, because people feel great about the results. Now they're worried about what's going to happen next week, what's going to happen next month with rates and with credit overall. We did also point out that we saw an inflection point in our delinquencies for personal loans, which is an important milestone as well.
All right, do you think, Anthony, that there's the possibility that people still remember the heritage, which is student loans, and they say, as President Biden forgives student loans, I can't own SoFi stock?
I do think there's a legacy of us being predominantly a lender. On the earnings call, as a matter of fact, we had analysts ask questions. 99% of them were about lending. There was only one question about the financial services segment and a question of whether we could sustain the 80% growth or not. And I talked through product growth of 40% and revenue per product growth of mid-20s to 30%, which there's still a lot of upside in both of them. And their focus continues to be on the thing that we used to be as opposed to the thing that we've become. And we're trying to emphasize the magnitude of the innovation we're driving. We've rolled out alternative assets, which helped us drive 58% growth in AUM and brokerage. In addition to that, we're providing auto, home, and life insurance. Our credit card business is starting to make a turn. And so we're seeing really strong trends outside of the traditional lending business. And it's going to take a while for people to accept that that's the driver of growth going through the rest of the year.
Well, I think that's really important. I mean, you do allude to the fact that you are becoming the AWS of financial services. And Anthony, I've known you for a very, very long time. And I thought to myself, when are people going to recognize that this is actually an enterprise software company that caters to individuals, not individual borrowers, but individuals? And why is that so hard? Why?
Okay, this is a good question by Kramer. He's saying, hey, why aren't you being valued as a SaaS? This is like the only thing I care about. Let's see what Noto says to this.
Can't people see that it's enterprise software?
You know, I think it's just a matter of people hearing the metrics over and over for the first time. So today was the first time we talked about our interchange revenue, which is growing very nicely. We also, for the first time, started to break out the growth in AUM, as well as our non-interest income and financial services, which ties to those two numbers. And they're much more transactionally driven without a lot of risk, and they don't require capital.
That was not an answer. That was not an answer. Kramer has a very simple question. Why aren't you guys being valued like an enterprise software company if you guys have an enterprise software stack? Noto says something about interchange revenue. That is not an answer. He needs to explain what the fuck their enterprise software is, which is this whole Galileo payments B2B API. He has not mentioned anything about that. This is why the street thinks of SoFi as a bank. Every time I say SoFi as a bank and people get upset, this is why. Because when he's asked on live television to talk about the enterprise software, the SaaS part of their business, he says, well, we make interchange revenue. It's like, no, dude, that's not going to get the job done. That is not selling the vision of SoFi as a tech company.
Anthony, finally, just on the macro, obviously we don't expect we're going to get a rate cut tomorrow, but we do, or many expect that we're going to get a rate cut come September. What's that going to mean overall for your business?
A declining rate environment is positive for a business. It will definitely be a tailwind. It'll increase the amount of home loan refinancing, which we're now in and doing quite well. We saw a very strong trend in home loans, up 71% year over year. We're now also doing home equity loans, which is a good diversification because it's a secured product. So both those businesses would benefit from lower rates. Student loan refinancing, to Jim's point, there would be a lot more demand for student loan financing because the rate they currently have relative to a lower rate, benchmark rates, would give them more of a savings. And so it would be a tailwind there. I also believe we'd see a tailwind to our invest business, which is also seeing great growth in AUM. But as people have less yield in money markets and fixed income, they're going to have to go back into equities as a higher percentage of their portfolio. So that business would also benefit. And then last, the value of the loans in our balance sheet in declining rate environments generally increase the value, all else equal, in the loans.
Right.
Well, look, Anthony, I again, people call in all the time on Mad Money, and all I can do is talk in praise. You're doing exactly what you can do. It must be frustrating to be you, but I want to thank you for coming on Squawk on the Street and always telling it straight.
Thank you, Jim, and thank you, David. Really appreciate it. At SoFi, I said in the earnings call, we like hard.
Okay, I don't care about that. We're gonna go back to the tech answer because all of this, we like hard, we like gritty culture. None of that matters if you can't answer this question. We're gonna listen to this answer again to really break down why I don't think he's answering this question. So let's go back to when Kramer asks it, and then we'll analyze exactly what he says.
And own SoFi stock?
I do think there's a legacy of us driving. We've rolled out.
I think that's really important. I mean, you do allude to the fact that you are becoming the AWS of financial services. And Anthony, I've known you for a very, very long time. And I thought to myself, when are people going to recognize that this is actually an enterprise software company that caters to individuals, not individual borrowers, but individuals? And why is that so hard? Why can't people see that it's enterprise software?
Okay, we're going to listen to exactly what he says and then answer it again because this is important to understand the broader SoFi thesis.
I think it's just a matter of people hearing the metrics over and over for the first time. So
his first answer is people need to hear the metrics over and over for the first time. I don't think that even comes close to the 50,000 people watching this on live TV right now about why SoFi an enterprise software company. Like, this is the moment where you explain, hey, Jim, so that's a great question. SoFi actually has a B2B payments platform that we acquired for $1 billion 4 years ago and blah, blah, blah. He says people need to hear the metrics over and over. What metrics? What people? New investors that don't know anything about SoFi, what metrics are you talking about to get people to even care about this enterprise part of the business?
Today was the first time we talked about our interchange revenue, which is growing very nicely. We also, for the first time, started to break out the growth in AUM, as well as our non-interest income and financial service.
No one cares about AUM, non-interest income. Someone in the chat right here says Stripe. That's exactly what Noto should have said. Noto should have said, you know what, Jim? There's actually a really popular fintech valued at about $90 billion right now called Stripe. We are doing something very similar to Stripe, and I don't think the street is recognizing that, maybe because they just haven't had time to really go through our business. Maybe I haven't done the best job communicating that. So I would like to communicate it right now. We are doing what Stripe is doing for consumers, for businesses via our banking API. Those two sentences put SoFi and Stripe in the same category, at least from the CEO's mouth. And now investors can at least be like, hey, maybe let me look up Stripe. Let me see what what is Galileo? It is a competitor with Stripe. That gets the conversation started. But AUM and non-interest income, what the heck are you saying? Who cares about that right now when it comes to the tech part of the business?
Which ties to those two numbers. And they're much more transactionally driven without a lot of risk, and they don't require capital.
Anthony, finally.
That is not an answer, dude. That was 30 seconds I would have taken the rest of my time on this interview and saying, guys, I really want to answer this question. So like, just give me a couple minutes to let me talk and get this out. I think Noto is afraid to classify themselves as a tech business because that answer, well, we separate the non-interest income from the assets under management and people just need to keep seeing the metrics. And like 2 sentences on your moat as a tech company to get a SaaS multiple, which every SoFi bull in the planet is telling me it's not a bank, it's a tech company, that it deserves a SaaS, deserves a Palantir multiple. How? Where do you get the Palantir? Forget a Palantir multiple of like, 27 times price to sales. How do you get to like 7-8 times price to sales if you're not going to really show off the tech? So I think that is the fundamental problem here. SoFi up 2.2%. So up a little bit from that 738 level. But, and this frustration is not in malice. I'm not trying to be like mean or malicious here. This is more so like, hey, it's time. It's time to really communicate this effectively. And he's not doing it at all. At all. That was not an answer. If I was his public speaking coach, he would have came off that interview. I would have looked him dead in the face and I would have been like, that was horrible, Anthony. That was absolutely horrible. Just like I say to my kids when I coach them in debate, I was coaching them the other week and one of them gave a pretty shitty speech. And as soon as he was done, I was like, Pranav, that fucking sucked. I was like, and he started laughing. And I was like, you're laughing because you know it sucks, right? Like we're gonna be honest with each other. That sucked, right? Let's fix these things. I think someone needs to tell Noto that this communication is not working around the tech part of the business. It's just not working. So there we go. And even Kramer set it up. He said, you call yourself AWS a fintech. Even that branding of AWS, that's so powerful for investors to hear. Noto does not lean into it. He just does not lean into it. SoFi right here at 746. Palantir 2718. Vlad does the opposite with Robinhood. Robinhood right here, 2120 on the day. Vlad says, we are building one of the most important financial services company. We're disrupting Schwab. We're taking market share from fucking Fidelity. Vlad is tweeting Michael Jordan dunking over people memes. Like Vlad's in it because Vlad, I think, believes they're a real tech company. Whereas I think Noto doesn't fully believe that yet, or else he would be talking about it in a way that actually makes sense. Is the thesis still intact? Yes, the thesis is still intact, 100%. But the problem with the thesis is that people want a multifaceted part of the thesis that doesn't just include lending and financial services, but also includes technology. And that's a big part of the thesis to give this damn stock a multiple. And every time it's time to flesh out that thesis, even if there's nothing there, even if there's not enough growth, even if he just has to paint a fairy tale to get people to start looking into the broader thesis of the tech part of the business, he does not communicate that in a way that I think, is meaningful enough for shareholders to get behind. And I think that's why the stock fails to get a tech multiple. 745 on SoFi, Palantir 2712, IWM still breaking out at 223, PayPal up 7.54% on the day. CrowdStrike is about to go under 240, down 6.92% on the day. Again, at 200, this thing gets really exciting. I think at 300, there was a dip. At 280, there was a dip. And then we realized the lawsuits were really going to take place. So now let's see where that one goes after their Q2 earnings. Pfizer's at $30.90, McDonald's at $2.62, Amazon at $1.83, and then JetBlue, look at this one, up 16% off of a 172% beat on EPS. So not bad for JetBlue. Am I sounding crazy though in the chat? Like, am I sounding crazy around this Noto thing? Am I being way too harsh? Because I feel like this is pretty reasonable, dude. Like as someone who has some SoFi, I think it's pretty reasonable to ask this. Like I will never have to ask Karp to explain the story of Palantir. Whether or not the stock reacts to that, he can't control, I can't control. But the one thing I can ask from, the one thing I can want from Karp is to make sure that he's communicating a story that is very complex, that has a lot of moving pieces, which is Palantir. And he always communicates that story. And because of that communication, I believe the byproduct of that has been Citi raises their price target. Jeffries raises their price target. Dan Ives raises his price target. Like the entire street starts talking. I mean, for goodness sakes, Jeffries yesterday said Palantir is overvalued, but we're still upgrading the stock from 24 to 28. Why? Because at the end of the day, there's something about Palantir they don't fully understand, but they do believe it's worth more. They think there's some momentum here that's just bigger. And that's probably because Karp is not boring. And when they listen to the keynote and they have to make their research note every quarter, they're like, damn it, this guy sounds too fucking confident. Maybe he has something up his sleeve that we don't know about. Here's an upgrade on the price. A lot of times that's how stocks trade. And for a company like SoFi, which is still very speculative, I think they need to have some of that energy as well. Here's what Citi said on Palantir today. Our recent HQ visit left us incrementally positive on commercial AIP momentum, though we think monetization and revenue traction is in the early days. We expect a revenue beat. The price target raise reflects higher commercial and government long-term growth rates. So they went to the HQ, met with Palantir, and they felt that although revenue and monetization for AIP is not happening anytime soon, which I agree as well, probably a couple quarters away, the commercial momentum based on customer conversion should be there. So they probably expect a beat on the top line, a beat on customer count, and a slight beat on overall monetization of AIP, but that is enough to justify $28. Rishi, our boy from RBC, also put out a price target. He reiterated $9. He said, Palantir is the only name we track trading at 20 times 2024 revenue. We cannot rationalize why Palantir is the most expensive name in software. And again, sometimes you can't rationalize it is because there is a broader story, aka from the leader, Karp, that makes that story attractive to investors. Absent a substantial beat and raise quarter elevating the current growth trajectory, valuation looks unsustainable. So that's a basic read from the street. I think Jeffries, Mariana, Dan Ives, all these other guys are coming around and basically asking, or basically saying that, hey, it's time for people to start respecting Palantir a little bit more based on their moat when it comes to AI, even if the valuation is up a little bit. Thomas says his answer wasn't wrong in terms of analysts understanding the company. They need to see the right metrics until they start using them to value them in different ways. I fundamentally disagree. His answer was horrible. His answer, it wasn't wrong, but dude, you're on live TV with Jim Cramer. You're not supposed to be giving an analyst answer. Like this is basic like PR coaching 101. Like if you're on Cramer, you're not speaking to the analyst. You're speaking to retail. Like you're speaking to hundreds of thousands of people that are just like having CNBC in the background. They know something of SoFi. They take a look, they watch for a couple minutes and then they go away. Like you're just trying to get the seed planted into people's brain that SoFi is different than everybody else. And they're more like Stripe, or they're more like, a B2B tech platform that's growing really quickly. You're not supposed to be talking about assets under management and net interest income when you're asked about the tech part of the platform, when Cramer sets you up with this whole AWS of fintech narrative. So I disagree. I fundamentally disagree. Like when it's time to get on TV and talk your talk, it is not time to sound like you're talking to the analyst. You just talked to the analyst for an hour. We just listened to you talk to the analyst. Like the analysts aren't watching the interview. They just got done listening to your earnings call. That was the time to talk to retail and explain this tech part of the business, and he's not doing that. CrowdStrike down 7%, 239. CrowdStrike, get this sucker to 200, yo. Let's go long on a generational name, down almost 50% from its peak. I mean, that would be exciting. Let's see if it can keep getting hit, and we'll see what happens on Q2. PayPal's up 8%. IWM still up. SoFi now giving back pretty much all of the gains. They're 2 cents away from going red. And by the way, I don't like when SoFi goes red. Okay, that doesn't make me happy. I have a bunch of options. I'm trying to sell them. I'm trying to get some juicy gains on this. SoFi, I would love for SoFi to be $9 right now, dude. I have zero pleasure. I'm not what do you call it? A masochist? A masochist? What do you call those people that like pain? I don't like that for SoFi. Okay, I want to see it go up. But you just got to be objective. When Noto needs to talk about the tech platform and he doesn't do it, we have to call it out. And now SoFi goes red. Masochist? Oh, masochist. Right. That's how you say it. Masochist. Did I say Mac OS? Dude, if I can't say turquoise, you thought I was going to say Macoist? Macoist? I still can't say it. Macoist correctly? Like, there's no way I was going to say it correctly. There's no way. Masochist. Thank you, Kris. You spelt it out. This is what I need on these words, okay? I need the syllables and all that shit. Come on, bro. There was no way I was going to get Macoist correct. Like, you guys know I wasn't, like, as soon as I started saying it, I realized I just fucked up. Like, there's no way I was going to execute that properly. All right, SoFi's going red, down 0.68%. PayPal still holding on to 8%. CrowdStrike getting hammered, down 8%. This is why I didn't want to continue buying the dip on CrowdStrike, dude. I mean, like 5 shares is fine, but if you bought 100, 200 shares when it got to 270, 280, now you're really sitting on some losses. If you bought 5 shares, all right, you're down $200. It's like, that's fine. But let's get this sucker to really go down and let's see who we can go long. I still think their second quarter is going to beat. I think they're going to have a really good second quarter. The problem is that guidance is going to be horrendous. And that is what should get this stock down substantially more. No one's stepping in to buy the dip either. Everyone is scared at this point, which is good. We have really good fear happening right now. And now we just want to see if we can get even lower. because the like sort of fundamental DDO on CrowdStrike is that it's a no-brainer. Top 2 name in the industry. Cybersecurity is growing. You go long on it. But now it's a question of how greedy can we get on the entry price to get a really good opportunity to go long. SoFi is now down 1% on the day. 727. Jobs data is out. All right, we got the jobs data. 1 second. Let me pull it out. Thank you for that, Ricardo. Let me pull that up real quick. JOLTS report is out. 3.28 million job quits in the United States decreased to 3.28 million, which is the lowest from November 2020. 8.18 million are open. Jobs are open. 8.18 million jobs are open. Forecast was 8.02. Previous was 8.14. So we have 400,000 more jobs that are opening. That means more people are unemployed. That means we're getting this rate cut. I think that's why SoFi might be, that's weird. SoFi potentially should be going up on this. Is IWM dropping on this news? It's dropping a little bit right there. Pound share just dropped. Yeah, growth stocks are probably dropping on this news because that means we are getting closer to a recession. Not anytime soon, I think, but unemployment is going higher. And yeah, well, look at that. Nvidia just fell 3%. Yep. So what we're seeing in tech right now, why we're seeing jobs, where we're seeing tech fall, the NASDAQ has to be red right now. Hold on. The NASDAQ. Yep. There you go. That's red. Okay. See, I'm getting decent at macroeconomics where I can predict a little bit of the price action because of the data. So the jobs data just said, hey, there's a lot of people that are continuing to be unemployed. As those people continue to be unemployed, that means the consumer spend will come down, right? It has to come down. And if consumer spending has to come down, then you're likely going to see earnings come down for companies. And if earnings starts to come down for companies, we are headed into a recession. Now, that's not happening anytime soon. And the Fed can cut rates to stop that from getting as bad as it can get. That's why September is baking in a cut. However, tech is going to suffer in that environment. And as a result, you're going to see a lot of stocks down. So let's go through big tech right now. NASDAQ is down. S&P is slightly green. Nvidia just hit 108. I think the dip will get eaten up, but the algorithms will dump them immediately. Tesla's down. Big tech is slightly green. They were more green, so we do have some red candles on Meta, Google, and Amazon, but they are still green for the day. Rocket Lab, yeah, a more speculative growth company, that will definitely be down 1% on news like this. Robinhood slightly down, and then Bitcoin slightly down as well, down 0.44%. So 400,000 more jobs that are open than expected. Whether or not you believe in how the number was calculated via the estimates, that is obviously a number that the markets don't necessarily love. Let's get to that news right now.
Openings and labor turnover known as JOLTS. JOLTS coming in near expectations, 8,184,000. Actually, that's better than expectations. And you see interest rates moving up a bit. Not only was this a bit better, that's a June read. Last month was revised from 8,140,000 all the way up to 8,230,000, which means last month is the best month since March when it was 8,355,000. And of course, this fits right in a little bit lower. And it turns out that now this is the lowest level since April before the revision. And if we look at consumer confidence, these are July reads, 100.3 on headline, better than anticipated, although we had a big downward revision in the rearview mirror. 100.4 for June now becomes 97.8. That makes 100.3 the best level since May when it was 101.3. If we look at the present situation, 133.6, sequentially following a down revise, 141.5, that becomes 135.3, now 133.6. That is the lightest level going back to April of 21. Now, if we look at what may lie ahead, expectations, 78.2. Sequentially, another downward revision to June. 73 becomes 72.8. 78.2 now becomes the best read going back to January when it was 81.5.
And the 10-year is spiking on this at 4.182%. So yeah, again, some of these numbers might be revised, but that's why you're seeing tech take a little bit of a hit. I would imagine the semis are getting hit right now as well. Yep, semis are all down except AMD, slightly up. ASML, slightly up 2%. Dell up 0.53 and Lam Research up 0.79. So all the semis get a hit from this because if tech takes a decline and the labor market weakens and, Nvidia might not have as much GPU demand, I don't think that's going to happen, but like that's how the market kind of thinks of it algorithmically based on these numbers, then all of the downstream effects for semis inevitably take a hit. So there you go. That's the number right there. IWM should be pumping a little bit more on this because that means we're going to get a rate cut. I mean, this number, I think it just confirms we're going to get a rate cut. But IWM right here at 223 up 0.7% on the day. And the NASDAQ just turned slightly positive. So again, that dip was eaten up, but that dip did happen because of that jobs report. Robinhood at 21.19, Palantir 27.06. Palantir dipped to 26.93, now back to $27 on the day. Cool. Okay, there you go. Where is SoFi? SoFi. 739. SoFi again, slightly green, up about 0.67%, but giving up the majority of that 7% gain that they got as well. Lower unemployment means higher rates. No, I don't necessarily think that's the. Oh, no, that's correct. But we are entering into higher unemployment because we're seeing the labor market weaken. That's the problem. When we see more jolts, that means more people are losing their jobs. That means there's more jobs openings because people got fired. I mean, that's one of the reasons why jolts increase. Yeah, so if we had lower unemployment, we would have higher rates. If we have higher unemployment, we have lower rates. This jolts number to me indicates that we have higher unemployment. And we're going to get non-farm payrolls on Friday. I think we're going from 4.1 to 4.2. Even if we stay at 4.1, we're still up 60 basis points from 3.4 in the past 6 months. So I don't think there's a world in where the Fed raises, but I definitely think there is an easier world to believe in where the Fed cuts. Even the Fed former president wrote an article on Bloomberg on Friday saying the Fed needs to cut now. So I don't think Jay Powell lets September go without giving a decent cut. But I don't think it's enough for inflation to necessarily rank up particularly. Rate cuts again getting pushed up. Let me look at the CME watch tool as well and see what they say. So currently the probabilities, let me share the screen right now. Probabilities for September. For July is 4% for a cut. September is 87 plus 11, 98%. It's actually 99. 99 if you add the decimal points. 99% for September. So if we don't get one call in September, that's not going to be fun. That is not going to be fun. But we'll see what happens. Call Kris. Let me see if Kris picks up. Let's get his take on it as well. Let's see if we can get Chris's take on this. But yeah, so that is, I mean, market's factoring in September. Now we just got to see if it happens. Kris, what's up?
Hey, dude, what's up?
What's up? All right, I want to get your take on a couple things if you're free for 10 minutes. I think first let's start off with this JOLTS number. Any thoughts on the fact that we have more jobs available in the United States?
I mean, that's a good thing, not a bad thing. That's why the 10-year right now is starting to spike, because the chances of a rate cut go down when there's more job openings, because that means that there's more opportunity. It gives employees more flexibility to switch jobs and demand higher wages. So it's not necessarily a good thing. I will say, though, that I think it's a very short blip on the way lower, because I think right now the economy is starting to sour. And there's a lot of jobs that are out there, but maybe not the ones that everyone kind of wants. So we'll see what happens.
Yeah, because the non-farm payroll numbers that come out, if we get higher unemployment tomorrow do you think we go to 4.2 to 4.3 tomorrow?
For what?
For unemployment from 4.1?
Yeah, we could get there. I don't think it's that.
Because that's confusing with JOLTS, right? Like if we have more unemployment, but there's more jobs available, then it goes to show you, hey, maybe these jobs are only open because people are getting fired, which is where you're getting all the unemployment come from, or they're quitting, right? One or the other.
Just one of the things that we have to understand is, where are these job openings actually located? Are they in healthcare? Are they in the government side? One of the major problems that's been going on, and I'm not sure if it's going to get solved anytime soon, but the federal government's been spending money like there's no tomorrow. And I think under the right circumstances, the federal government needs to kind of dial it back, especially with the national debt where it is. Depending on which administration comes into power, you probably see a reduction in spend. And if that ends up happening, then you'll see that JOLTS number come down significantly.
Yeah, I think Don summarizes in the chat as well. There's two ways to interpret the JOLTS number. Number one, job openings means people are hiring, which is an argument for higher rates, which is why the 10-year spiked. But you could read that and think people are firing full-time jobs and hiring more part-time positions, which is why we have more unemployment, which is obviously bad for the labor market, bad for the consumer. But we need a lot more data, and I think JPAL probably needs more data to figure out, is that JOLTS number really bullish or bearish in the context of how we should think about rates? What do you think about SoFi?
I mean, every quarter, this is the same thing that keeps coming up. They're a bank. Let's just admit, let's call a spade, right? They're a bank. They have a technology platform that's layered on there, which doesn't seem to be growing as fast as a lot of people had kind of like originally made it out to be. So I think right now, if you value it like a bank, it's still overvalued by a significant portion. Now I will say this, as a bank, they are improving their metrics significantly. So right now, if you're buying this stock, you're looking at probably like flat growth for the next like 2-3 years. I don't think that it goes up, like any chance that this thing goes above $10, $12 in the next 2-3 years is an opportunity to sell covered calls. I mean, this is the perfect trading stock, in my opinion, because there's just so many retail investors like just living on this hopium that are just bidding up the premiums on the calls ever so often. So guys like TJ are definitely making their money on all these SoFi bulls, while the entire time he's just literally just selling them, some hopes and dreams, I guess.
Do you think Noto is not speaking about the tech platform because he doesn't have anything to talk about, or he just doesn't know how to communicate that part of the business?
He doesn't have anything to talk about. I mean, there's just you can't be bullish about a product that's not showing bullishness, right? So he would have highlighted it otherwise. He's not highlighting it.
I mean, you could. I could sell some shit to anybody if I sound smart enough, right?
I don't think he's that kind of guy. I think he's just he's a straight shooter. So he's going to give you the exact thing that's actually happening. I don't think he's the type of guy that's going to fake it till you make it kind of thing,
Yes, that is fair. Okay, last question for you. Regional banks, they're doing well. Your TFC called back to $45 when it was at 26. TFC currently is at 44.66. Why are the regionals doing well, and do you expect them to continue to do well if the Fed cuts rates?
Yeah, it's just math. When you think about the book value of a lot of these regional banks, they've been pretty much challenged because of AOCI losses on their balance sheet. So basically, these are loans that they had issued at lower interest rates, and so when interest rates went up, all of those loans became less valuable. But the good thing is when you start cutting interest rates, those loans become valuable again, in which case you can unload them. You can, treat them as closer to being par value. So, the chances of us getting rate cuts is relatively high, with the exception of the JOLTS report, which if you're looking at TFC right now, you can see that it almost got to 45 and it's now retraced back to like 44.65 based on the news. So it just goes to show that a lot of the regionals are more dependent on interest rate movements, and they're very interest rate sensitive. So with the prospect of future rate cuts kind of being baked in, you're starting to see people front run and buy up the stock. My price target for TFC with a 45 is there. I'm not raising it significantly. I think the real opportunity in TFC was actually not just in the stock, but on those damn spreads, man. They became overly just sold, and it was so cheap at the time. So all the people that got in, they're loving it right now, and I don't think that it's forming this level that's not going to go below the 45s anymore, in my opinion. I mean, maybe a little retrace a couple of points here and there, but as time goes on and the rate cuts start getting built in, all the people that are holding their spreads, they're going to get fully priced on them. So happy to see that.
Okay, last question on. Go ahead. And then one more question.
I think the most important thing that the market may or may not be ignoring is look at the sharp decline in Nvidia over the last 30 days.
Oh yeah, what are your thoughts on that? So give me your thoughts there.
So I posted this on the Patreon about a month ago about how there could be an AI bubble, not necessarily in the actual like utilization, but in the hardware space. And I really do believe that that's the case, where I think a lot of growth expectations were kind of brought forward significantly. And now we're starting to see this retracement at Nvidia and the other semi names. And I think this is only the start. I think they're going to be running up against very, very tough comps going into 25. And we could see, a lot of these semi names come down significantly. Now, that doesn't mean that Nvidia is a bad company by any means. It just means that the valuations may have gotten a little bit overextended, in which case the market's just going to punish them in the short term. And the thing is, like, that's just what happens when you have expectations go beyond what's normal. Eventually the market's going to come and correct you. And I think the one thing, and I know that this is going to sound like, oh, Kris is being that Palantir bear again, but a lot of the valuation premium that Palantir has right now is because of the prospect that AI is going to be a big thing. So any slowdown in Nvidia, I think, is a precursor to some slowdown in Palantir as well. And so the valuations are probably going to retrace a little bit, in which case Palantir is going to, at best, it's going to stay flat where it is. You're not going to see anything above the 28.30 mark. And at its worst, you could see this thing get back down to the low 20s again, and maybe even cross below the $20 level. So we'll see.
Okay, one last question, Kris, on PayPal. They're holding their 8% gain. They're buying back another $1 billion of stock. Does that entice you at all, given they're buying back even more, or still it's too risky?
I think it's a great company. I think they definitely have a lot of lasting power. They don't have any sort of like, I don't necessarily think that they're a bad company to hold, especially with all the share buybacks kind of like keeping their EPS growing, and they're still growing their top line, the bottom line. Like I said, this is a great company. The only thing that I would be worried about is just the valuation premium that they are likely to get dinged on by its competitors. Like the
Apple Pay,
the Cash App.
Yeah.
I think the biggest threat to PayPal, and this is something that I spoke to Matt about the other day, I said, is probably Zelle. It's an interbank system. Like right now, I was trying to send Matt some money, and Matt's like, yeah, I don't use Venmo, I don't use Cash App, I use Zelle. I'm like, oh, why is that? He's like, oh, I've had issues with both platforms. I'm like, okay. And it's funny because like I'm doing my closing with my lawyer and my realtor and everything else, and I have to like transfer some money to these guys for transactions. And the funny thing is, all of them asking me, just Zelle me the money. Like I was like, oh, you don't have Cash App, you don't have PayPal, because I don't really use Zelle a lot, but I realize how easy it is. All I have to do is just punch in the person's phone number. I see their stuff. It's easy to connect. It's easy. It's verifiable. It's a bank to bank. So I don't have to like log out of my bank. It's recorded in my bank statement. So I don't know. It just seems like Zelle is a great alternative, in which case in the future that might dissuade a lot of people from using Venmo exclusively.
Gotcha. All right. Yeah. Thank you, Kris. Kris's Twitter in the chat. Please make sure to follow him, and appreciate you hopping on. Thank you, Kris.
Thanks, man. Take care.
Take care. All right. So what do you guys think about this JOLTS number? Do you think it is more jobs, therefore the economy is expanding, or more people getting fired, therefore jobs are open, but that's not really a good thing because those jobs are kind of like zombie jobs? Like, there's a whole study a month ago that came out on like LinkedIn job descriptions and how a lot of these jobs are open, but they're not really open. And if you try to reach out to the recruiter, they're not going to respond to you, but they want to make it seem like the job is open. I think Don summarizes it really well. Either the JOLTS is bullish because for the economy, because people are hiring, that's bearish for lower rates, but that's bullish for like the broader consumer. Or it's bearish because there's so many jobs open, another 400,000 or the expectation was another 184,000 jobs are open versus expected, not because the economy is expanding, but because people are getting fired, and which would be conducive with the unemployment rate uptick we've seen. Therefore, those jobs are quote unquote open, but they're not actually open, and the consumer is going to be more weak. Obviously, the 10-year felt it's worse for rates, which is why the 10-year spiked. But I think there's a solid argument for both. Yeah, cap and crunches. I think most of those are zombie jobs. I agree. I think those 184,000 jobs that got opened ahead of expectations, that's not bullish for higher rates because those aren't real jobs. And we know that those jobs got revised 2 months ago when they took off 100,000 jobs from the April non-farm payroll numbers. Do you guys remember that? That was like, they said we added 300,000 jobs. We actually added 192,000. It's like, hold on, where did this 115,000 jobs go? And it's because they weren't real jobs. Sandra says definitely fired in zombie jobs. I agree. I don't think the economy is expanding to the point where we have that many more jobs available, especially because consumer spending is going down. So like, why would we have so many jobs up there and available? So I still think that's good for rate cuts at the end of the day. That's why as soon as the JOLTS number came out, in my opinion, I was like, oh, that's bullish for rate cuts. Because if we have that many jobs open, I did not think like if I saw that JOLTS number 7 months ago, I would say, oh, this is great. The economy is expanding. But given everything that's happened over the past 7 months, now I see that JOLTS number and I was like, no. These are not real jobs. These are people getting fired. We are seeing this in consumer spending. That means that's bullish for eventually cuts given the labor market is weakening. But I guess we'll get more clarity from JPound. We'll see over the coming weeks, and we'll see what happens there. IWM at 222 right now. SoFi is slightly green, 734. It's up by 2 cents. PayPal still holding its gains. I mean, PayPal doing okay at 8% up on the day. You got to give PayPal some credit given SoFi gave back most of their gains. Regionals are doing okay. Meta just settled a $1.4 billion lawsuit. I saw you guys mention in the chat. What lawsuit did they have? Meta agrees to pay $1 billion to settle Texas facial recognition lawsuit. Meta Platforms will pay the state of Texas $1.4 billion over 5 years to resolve claims the social media giant profited from facial recognition technology without user consent. Biometric identification is what Facebook violated in the state of Texas, and they paid $1.4 billion. Now, see, Facebook can afford to pay $1.4 billion. CrowdStrike cannot. So Facebook can pay the little parking ticket. CrowdStrike can't really afford to do that. So we'll see what happens with CrowdStrike. Where are they right now? CrowdStrike, goodness gracious, dude, 236, down 8%. At this point, if it's going to drop, like, it might as well drop. Like, it might as well take a nasty fall. I mean, it just doesn't seem like the dip. No one's buying the dip yet. It's just not catching a bid anywhere. Tried to get a couple green candles right here at 230 or 250, and then boom, had a nice little decline right here at 236.74. Chris's point about Zelle, I think, is also a really interesting argument. I use Zelle a lot as well. I send like my mom and my sister money through Zelle. Zelle is integrated with a lot of people now. SoFi did start integrating Zelle, so I think that'll be a good thing. But again, I mean, like my big issue with SoFi is that this tech platform is just not communicated that well. Every other part of the business is growing pretty well. The other part I didn't like about the deposits is that they only had 2.2 billion in deposits. Again, I don't understand how they're adding 640,000 members and they have 8.8 million people and they're only having 2.2 billion in deposits. Like, 2 billion in deposits is not a lot of money. I mean, I would imagine we would get closer to 3 or 4 billion. But maybe it's because not all of them are picking direct deposits. And that's the issue. Thomas says, I hope CrowdStrike becomes this year's Meta. I think there's a shot if it gets closer to like 180, 160. Because Meta had to get really undervalued. CrowdStrike is not there yet. Given the price of sales is still 17. PE is still 444. But obviously, if you're buying the dip on a name, you can never get the bottom perfectly, right? Which is the whole point of DCAing. So if you DCA at 270, 280, 300, I don't think it's that big of a deal. The question now is, do you have more data than you had back then? And the more data that we have right now is that the guidance will take a hit and the lawsuits will be in litigation for at least the next year. So there's no reason to jump in right now. If we know on Q2, George Kurtz is going to have to say that top line growth is declining. Now, if he somehow says, hey, our guidance is not going to get hit and we're going to keep growing at 35% year over year, free cash flow and annual recurring revenue, maybe the stock just jumps 20% that day because like they somehow escaped miraculously. But they're probably not going to do that. So we're probably going to get a little bit more pain. We have more data, and therefore the dip will get a bit more exciting in the 200s. if it gets there. Noto is going to be on Bloomberg in a minute if anyone cares. Let me see if I can pull that up. Let me see. Yeah, I would like to hear from him again. I don't think we'll hear anything that different. But let's see. Okay, yeah, I have it pulled up. As soon as I see Noto there, then we'll pull it up here if I'm on the right channel. I might not be on the right channel. So if I'm not on the right channel, then we won't see him. The lower deposits for SoFi could be because nobody's transferring in the brokerage. Well, I think that's the reason, right? And this is why when people compare it to Robinhood, I'm like, dude, it's not even like Robinhood actually has people put in money every day, not only because they're getting 1%, but because they like using the product. If SoFi is getting direct deposits, but they're not getting people using the Invest platform, that means they don't have active users. They said they have like 4 million Invest users. I'm really skeptical how many of them are active. And again, it's a problem that not only SoFi struggles with. Robinhood has 24 million accounts, only 13.7 million are active. So, even Robinhood has low activity. That's just the nature of how that business works. But the fact that they're not announcing it or reporting it makes me feel they have a really bad number on that monthly active user level, which is another reason why they might not have a lot of deposits. Amit, are you still holding your CrowdStrike shares? Yes, I have 5 shares. I'm holding those 5 shares. We're down $200 on the 5 shares. And I would love to get that to be 100 or 200 shares by the end of next year. But let's see if CrowdStrike gives us a really good shot. This time, see, the thing about CrowdStrike now, again, different with Meta, is like when Meta fell to $90, everyone was scared. I think that the lesson to learn from that is when it falls to generationally cheap levels, you don't get scared if it's an exceptional company. Meta is an exceptional company. CrowdStrike is obviously an exceptional company. And if you don't know that, then you just got to do some research. This outage was bad, but Meta had Cambridge Analytica, right? Meta had $70 billion wasted on the metaverse. Like every company has fuck ups and mistakes. Is it still a generational one of one? I think CrowdStrike is. But can we get greedy enough to get a valuation that mirrors what Meta was at 90? Maybe. Maybe that happens. And so I think we'll wait for that to see how bad it gets. Maybe Noto heard your advice on the stream a bit and we'll talk about the tech platform. Maybe that would be fun. And again, dude, I don't want to sound like I'm smarter than Noto, or I know, like, dude, he's one of the most successful people in business ever. Like he's an absolute boss. Like Noto is a gangster. It's just this one specific issue I don't understand why the communication is so bad. That is my only beef with Noto. I mean, he's an absolute rock star. He understands business. Goldman Sachs, Twitter. He's taken SoFi from a shitty student loan company to one of the better fintechs that's out there. But like, talk about the tech part. Like that's the only part. That's the only problem I have with him. It's the only issue, and I don't get why he doesn't talk about it. I just don't get it. I truly think he's pandering to analysts more than retail. Well, he needs to stop doing that. I mean, think about it, guys. There's a reason Vlad did the interview with me. Okay, Vlad, and when I was sitting there with him while they were setting up the lights, he was like, yeah, my board didn't want me to do this. And I was like, really? He was like, yeah. And I told him to fuck off because if we're going to talk to JP Morgan, we're going to talk to people like you. He said this word for word. And that's when I realized, oh, this motherfucker, he knows what's going on. He knows that like Amit speaks more to retail. And at the end of the day, you want to get an investor base that actually cares about your stock and like likes your stock. And if you do an interview with a guy who has the attention of retail more than just the analyst, you're going to get more people interested in the company. Like he's playing the game. He knows the game. Why has Noto not done an interview with Tanner yet? Why has that not happened? Why? I don't get it. Why? Like, even if the stock's in the gutter, why has he not gone on Tanner's channel for 5 minutes and just said hello to the guy who makes a video about him every day? I mean, goodness gracious, dude, fucking Vlad DM'd Tanner back and said, hey, I'm a big fan of your channel over Noto. Because even Vlad knows, hey, if I can get this fucking Tanner kid to start talking about Robinhood, like Vlad's playing the game. He's talking the talk. He's doing what he needs to do. And Noto's just not doing it. If you're pandering to the analysts hate you. The analysts don't like SoFi. They are not fans of SoFi, bro. What analyst has a nice price target? I mean, fucking Vlad has like $30 price targets from Bernstein, 29 from Wolf Research, 24 by Bank of America. The analysts are getting on board. But if the analysts don't like you in the context of SoFi, well, then you've got to get other people interested. And I don't think he's really talking to other people. At least not yet. Palantir, where's Palantir? Palantir, 26.94. Palantir down slightly. And again, the thing about Robinhood talking to retail, sometimes people are like, oh, well, you shouldn't talk to retail because retail's unsophisticated, whatever. Two things. One, I think Vlad genuinely believes that retail is not dumb money. Like, I think given he's built an entire company based on this, he actually like cares about retail a lot because he's built like retail is his customer base. If he doesn't care about them, then he really has no customers. Number two, they followed up with innovation after. I mean, when he talked to me after they had announced the credit card, the 1% deposit. So he wasn't talking to me when the stock was, not really doing that well or they weren't innovating. He was talking to me when like shit started really getting momentum. And I know SoFi hasn't unveiled a ton of new products, but if you feel like you're growing and you feel like the momentum is there, even if the stock's not there, forget the stock. At this point, if you feel the momentum's there and you're putting out new products in the credit card business, yada, yada, the tech business, I think you need to talk to retail, even if the stock is not reflecting that. Now, thankfully, Robinhood, when Vlad talked to me, the stock was reflecting that a lot. So it was like, it was great, right? Because the stock was reflecting that and he had innovations. But even if the stock wasn't reflecting that, you've got to get your message out there into the world. And the only way to get the stock eventually to reflect that is if you get your message out there. And I don't think Noto's doing that with the right parties. At least not at this point. So that's what we got right there. My average on Nvidia is 130. Yeah, so is TJ's average. We bought 200. Dude, I remember when we were buying Nvidia at 130. I was like, TJ, I don't like it at 130. He was like, well, you got to get in at one point. I was like, all right, fuck it. Getting 300 shares at 130. So yeah, we also have a 130 average. So I think the adjusted cost basis is like 115-ish, 118-ish on Nvidia. So don't feel too bad that you're down. Nvidia's down, what, 4% now? Yeah. Wow. 4.2% on Nvidia, 106. 106. Nvidia's down. Where's Path? Kathy's been selling a ton of Path as well. Path is 1220. So Path's actually holding up. I thought it'd be closer to 10. Path's at $12. Meta's at 467. QQQ just went red. S&P just went red. All right. So we got a red NASDAQ, a red S&P. IWM still slightly green on the day. Okay, so Noto's not on my Bloomberg right now, the Bloomberg Live that I have. Maybe he's on a different one. I don't have Bloomberg on YouTube TV for some reason, only CNBC. So, yeah, I don't know if I have Noto here. Yeah, it's weird. It's not here right now. It's weird. I thought he would be on the regular live stream on YouTube, but he's not there right now. They're having like Bloomberg Radio. So we'll see if we get that. Probably closer to market close. Semis are still red. Are semis red? Where's the semis? Yeah, they're red. ASML is a little green. AMD is holding on by a thread. AMD and Microsoft are after the bell. And so are Starbucks and Pinterest. So we're going to have to see that. TJ, what's up? He said COVID got his wife. Damn, dude. I know a couple people that got COVID last week as well. So it seems like some more people are getting it. TJ says, who gives a fuck? It's fucking Nvidia. Yeah, well, there you go. Now we just got to hope Nvidia does what it does. 107 right here, down 4%. So the dip here on Nvidia, again, it does seem a little bit similar to what Kris talked about, which is some of that demand was pulled forward and weakness in the NASDAQ is when you see weakness in Nvidia. However, it is still Nvidia, and that conference we saw with Jensen and Zuckerberg just goes to show how much revenue they're really going to bring from the hyperscalers. Now, one thing on an election year, I saw this chart today that's really interesting. Every August of an election year, we have a higher month that's green. So take a look at this chart. So for the past 32 years on the S&P 500, on an election year, August tends to be up 100% of the time. October tends to be down the most. So October is the worst month of an election year, and it is the most red month. November, December are usually up. August, which we're about to head into, is up. So although I've been saying August is seasonally choppy, in an election year, apparently August is not as seasonally choppy 100% of the time. 32 out of 32 times the S&P is up in August. So wherever the S&P closes tomorrow, we'll see where it opens on August 1st. And then historically, it should be up for the rest of the month. But October, we see a little bit more weakness going into the end of the month. TJ says 130 isn't a good price, though. Hope it tanks to like 80. Yeah, if Nvidia goes back to 80, $90, I'm going to be curious where the dip buyers are, because I mean, that's 800 pre-split, right? The PE is going to start going, the PE is going to probably collapse by 40 or probably at least 35%. So the PE of 62 or PE ratio of 43 probably becomes closer to like 32-ish, 34 if we get down to 85. If they grow triple digits, which they're still going to do next quarter, I don't think it's going to be 200%. I think it's going to be like 180%. So Nvidia theoretically would still be cheap, but the question is going to be, what is going to be the appetite for Nvidia if it gets back down to 80 or 90? I would like to say that this is not a normal election year. That is also true. Nothing has been normal over the past 2 years now, quite frankly. So we'll see. Micron has been crushed after earnings. Yes, Micron has been crushed after earnings right here, 105. They were at 150, and they fell to 129. They got crushed badly at 105. I was actually thinking of buying Micron shares before earnings, but I didn't because I really didn't understand the business, quite frankly. I thought they would crush on earnings, and they did. They grew revenue 82%. It's just the stock. And I think that's the trend, right? The stock was up 75% year to date. A lot of these stocks are up a lot. PayPal still holding its 8.5% gain today. And even if they crush earnings, it's just asking a lot of the street to give you another 20, 30% after they already gave you 70%. So I think a lot of the profit taking just exists from that angle. Can you make more tubs of mayo bets with the chat? Dude, I made a pretty good bet, right? I said, if JPOW raises, I'll eat a tub of mayo. We're not going to see JPOW raise, so I'm not eating this tub of mayo. Now, what I'm not going to do is say, oh, if JPOW cuts, I'll eat a tub of mayo, because there is a chance, small chance, that JPOW does a little cutty cut, and then I have to sit here and eat a tub of mayo. So I am making bets that I can win. And because it's mayo, dude, I'm not going to make a 50-50 bet when mayo's in line. There's just no way. Define tub. Someone sent me the Amazon list yesterday. The Amazon list for the tub of a bucket of mayo. Someone actually sent it. It was hilarious. Yeah, this is the bucket, dude. Oh, I'm like throwing up even looking at this thing, dude. This is the bucket. Could you imagine eating this, bro? I look at this right now and I get goosebumps. Like, so I'm gonna keep making bets that I can win because I'm not gonna allow this to happen. I won't. $102, bro. Goodness gracious. This looks like hell. Like you know how people describe hell? This right here looks like hell, bro. Look, it's even called Hellman's. What type of name is Hellman's? Nonsense. Hellman's. It's because it's hell. It's because it's a precursor to going to hell. That's what it is. All right. And we're going to make sure we never have to eat mayo. Ever. Derek says, stop comparing SoFi brokerage to Robinhood's brokerage. It's like comparing Tesla Semi's revenues to Peterbilt's. Okay. So first of all, I do the least comparison between SoFi and Robinhood. It's all the SoFi bulls, the ultra bulls, that keep comparing it to Robinhood. And then I have to chime in with like, hey, you guys really don't understand what you're talking about here. So I think I compare them the least. Number two, I think it's fair to compare them to the extent that SoFi wants to be a one-stop shop for your financial resources. Now, let me give you the point that SoFi has less than 1% of their revenue come from the brokerage business, which is why I don't really care about their invest platform, because it's not really the business. The business is bank, it's lending. Robinhood is trading. It's a different business. However, if you're going to be a one-stop shop for financial resources and grow top-line deposits and user engagement, and you have a crappy brokerage app, or at least a brokerage app that's not really that innovative, that's where the comparisons become in. Because if that money's not going to SoFi, it's going to Robinhood, or it's going to Schwab or Fidelity, or it's going to somebody other than SoFi. So the opportunity cost of not innovating on the invest platform, even though it's not a big part of the business, to me is massive. And if you're a real tech company and you've got thousands of employees, I don't understand how you can't lock 500 employees in a room and say, just make this tech platform the best platform ever in the context of the investing app. And they haven't done that yet. And that's probably because it's really hard, which is why I don't think people give enough credit to Robinhood. Like, it's really difficult to build a brokerage app that people want to use. So I don't think it's about comparing them. It's about wondering, like, hey, if those deposits aren't going to SoFi, then ultimately where are they going to? To be fair, did you explicitly say you would eat the entire tub of mayo in one session? Yes. Yes, I did. So if JPOW raises rates, folks, you will see that happen. But I don't think that's going to happen. I picked a fight that I can win. Look at JetBlue. Oh, my God. By the way, JetBlue, you know who's happy today about JetBlue? You know who's happy? Vlad. Not Vlad Tenev, but Vlad that called into the channel who bought the 50,000 shares of Palantir. Remember, I showed you guys the SEC filings? He has over 20 million shares of JetBlue. Like he had to literally disclose publicly the SEC filings because he has that many shares of JetBlue. So the guy who's happy today, who's really happy, look at JetBlue up 20%. That means every cent he's up like $200,000. That's how crazy these numbers get. So he must be up a lot of millions today. So JetBlue is up. JetBlue is up. Let's look at the other airlines, given JetBlue is up. United Airlines, 47.42. They're up 1.42%. Delta is up 1.87%. And then Southwest is up 3% on the day. So airlines doing well. Not too bad. So that's what we got. That's what we got there. And here's the form if anyone wants to see it. I'm putting it in the chat. I showed it a couple weeks ago, but when you own these many shares, you have to disclose to the SEC that you actually own these many shares, dude. It's crazy, bro. Absolutely crazy. 17 million shares, bro. That's a lot of shares. Okay, so that's what we got with JetBlue. PayPal still holding its gains, and then SoFi. Where's SoFi? Is SoFi up? SoFi slightly down still, down 20 cents. PayPal, I'm surprised PayPal's holding, dude. I would have expected PayPal to collapse by now, given its historical trajectory. PayPal's still up 8.5%, which is not bad. HWT is up 13%. HWT. Is this an OTC stock? It's not on Webull. That's weird. Maybe I'm typing it wrong, but that might be OTC. Micron 105, Nvidia 107. Where's CrowdStrike? Are they in the 220s yet? 235, down 9%. Down 9%. NVAX. NVAX. What is NVAX? Noravax. Wow, they're down. Novavax, 25%. What does Novavax do? Did anyone own this one? Novavax Biotech. Do they have earnings today? Let me see. Do they have earnings? I don't see their earnings, but maybe they did. Or did they have a lawsuit or something? 25%, $1.7 billion company. Novavax. COVID biotech. Yeah, a lot of those COVID biotechs starting to get hammered. I mean, Ginkgo Bioworks is the premier one on that one. I feel greedy not buying the crowd dip and waiting for more of a drop. Look, I mean, if your goal is to get to 100 shares of CrowdStrike, buying 10 right now, 10% at this level is not crazy. You're buying 5, but I wouldn't buy like 50, right? Just because there's so much we don't know going into Q2. So you don't have to literally hold out forever until you get the price you want, but I don't think it's time to go balls to the wall yet on CrowdStrike. They got a downgrade from $8 from JPM. Okay, that's fair. Everyone keeps saying to check Serve. Guys, we looked at Serve. Serve is a company that IPO'd in April, and Nvidia invested in them. That's why this thing is up. That's the only reason. They literally IPO'd. Hold on. Let me pull up the another chart. The only reason these guys are up is because Nvidia invested in them. And yeah, so they were listed on April 18th, 2024 at $4.75. They fell to $1.82. Now they're at 2046. So it's up 330% in the past year. It's up 20x from the lows. It's great. And I know it keeps going up 5% every day. But who the hell wants to legit buy a stock that's up 20x in the past 3 weeks and think you have more gains coming? Sorry, not 20x, 960% in the past month. So 10x. I know it looks cute, but it's like no one, like if you want to buy this, be my guest. But this is not like, this does not feel like it's a easy buy to buy something that's up 10x in 3 weeks. Like that seems like it's a recipe for a disaster. So I don't think it has to collapse, but I definitely don't think it's something that should get retail excited because you missed the run. I mean, it's up 10x. If it goes up another 10x, then all right, I was wrong. But I don't know if there's that much more momentum left in Serve. CrowdStrike 235, that's down now 9% on the day. They're probably going to do a share offering. Yeah. I mean, I would imagine. Serve has how many shares outstanding? 243 million. It would be stupid for them. Oh, no, that's CrowdStrike. Serve has 37 million shares outstanding. It would be pretty stupid, in my opinion, to not issue out 20 million shares. Even if the stock falls 50%, shareholders are still up 500% for the month if they got in the low. So to them, they're going to be like, hey, we're still performing really good this year, even if we're not up 2,000%. Market cap of 778 million. I would do a share offering if I was them. Price to sales of 3,711 on Serve Robotics. Please stop mentioning this name. There is no reason we need to look at this name. I mean, I'm all for paying a little bit higher of a price to sales. Obviously, if you're buying Palantir, you feel that, but 3,700 price to sales? That's not even PE, dude. That's price to sales. That's like, you think ARM is overvalued at 48 price to sales? Like, it's up because Nvidia invested in them. They took an equity stake in the IPO. That's why they're up. So yeah, I would just be a little cautious of Serve. Do you think Noto can hit that 2026 $45 price target for his juicy PSU bonuses? I think if he starts talking about the tech platform, then maybe. But $45 for SoFi right now seems like a pipe dream in 2 years. Because how does a bank, like, a banks don't go, that would be what, a 5x? No, a 7x? Yeah, basically 6x. A 6x in 2 years, 600% on a bank in 2 years. I don't think that's ever happened. Does anyone know if that's ever happened? A bank goes up 600% in 2 years. A tech company has gone up 600% in 2 years, I think, many times. Hell, a robotics company just went up 1,000% in 3 weeks. But that's because investors are willing to pay for the perception of further growth and free cash flows, because the technology aspect of the business is what entices a certain class of investors that has been growing since 2010. And obviously, big tech with the Mag 7 have shown it is a profitable business that can deliver shareholder gains. Unless Noto makes this a tech business, I don't see how it goes up 600% in 2 years. There's like no way in hell that could happen, bro. There's just no way in hell. So I don't know, dude. I don't think we see that. So those $45 PSUs, they might as well just like, they're just like on paper. Like even the $25 PSUs, how do you get this thing to 3x or 4x? Has a bank 4x'd in a year? Or those expire at the end of 2025. So let's call it 2 years. Has a bank ever 4x'd in 2 years? Even if we get rate cuts, even if we get more lending growth, like that's not enough to 4x a bank. Because then it's going to be trading massively above its tangible book. If SoFi goes to $25, and let's say they hit their guidance of growth, which is like, let's call it 15% growth over the next 2 years, they're going to be trading at a book value of closer to like 15. Banks trade on average of 1 to 1.5 on the high end for book values. Most of them trade at around 0.8 to 0.9. I just don't think there's a chance in hell unless it legitimately becomes a tech platform. Otherwise, it's going to be tough. The stock was around $20 when they issued him those stocks. $45 wasn't much of a long shot. Yeah, that's the other thing. In 2021, the stock was $20. That's when Chamath pumped it up and left everyone holding a bag. But yeah, I mean, when interest rates were 0 and the stock was 21, then 45 seemed likely. Not when it's at 7, unless they have a massive. I mean, look, when Robinhood was at $7, Robinhood I think down right now. Robinhood at 21.03. When Robinhood was at 7, and I bought call options for $20. I felt it was asking a lot, but I didn't think it was impossible, because I just felt like if we had a crypto run, a bull market run, Robinhood would capitalize on that. Now, I didn't know they would do everything they've done this year, and I'm super proud of them. They've really executed. But they took advantage of the moment and they went for it because they're a tech company and they have fixed costs and they can, push out innovations, etc. If SoFi wants to do a 7 to 21 type of move like Robinhood, they've got to be more than a bank. They just have to. So I guess we'll see if they end up playing that out. Does Roaring Kitty know about SoFi? I think he does, but he's more into the Chewies of the world, which are currently up 2.5% of the day. Now, ASTS, this has been a magnificent ticker. It's down 5% of the day, but ASTS, if anyone has been in this one, it has done very, very well for people. And the reason for that is because they got a big contract with telecommunications provider T-Mobile and AT&T, if I'm not wrong. And this stock year to date up 268%, over the past year up 316%. So they were at $2 in May. Currently they're at 17. If you saw this one coming, congrats, because this was a good one. But they're a satellite designer and manufacturer, and they got some pretty hefty contracts. They're up 500% in the past 6 months with T-Mobile and AT&T. So those contracts are what's leading it to gain its momentum. I don't know if it's expensive right now. I mean, I have to go through the numbers. I haven't gone through the numbers, but it does seem like there's a fundamental reason, not like a meme stock reason, why the stock is up. Whereas Serve Robotics, it seems a little bit more memeish, just given that it's up because Nvidia invested. They also have a massive non-disclosed contract with the government Starlink competitor doing VSAT. Yeah, so there you go. The ASTS is not a meme stock in my opinion. Now, it might be trading a little bit aggressively, but they've had real growth to justify the revenue multiple. But Serve Robotics, again, don't know enough about the financials other than, hey, I mean, it's starting to get up there in terms of how pricey it's getting. Now, granted, we could see a correction in ASTS as well, dude. I mean, when you're up 500% in 6 months, that is a little unsustainable as well. So I wouldn't be surprised to see a correction there. So buying it at these levels is a bit tough given the run already happened. Same thing with Serve Robotics. But you got to see how the company continues to progress and what new milestones they hit coming into Q2. Space is hot right now as well. Yes, 100%. Space is also hot right now. No Stress Invest says SoFi is not going to 25 until they become a full tech company with Galileo and it's not showing growth. Big trillion-dollar companies are growing faster, solid management, but not a tech company. Yeah, I would agree. And I don't think that's a horrible critique of SoFi at all. I think that's a very sophisticated critique of SoFi. And it's reasonable to say, hey, we need more clarity on the tech side of the business. And again, one of the reasons Noto might not be talking about it is because there's just not enough to talk about, as Kris said. In that situation, he needs to call up your boy, and I will consult with him on how to talk about things when you don't have that much stuff to talk about. Okay? Sometimes it's a slow news day. You got to start talking about things, all right? And you got to figure it out. You got to keep people engaged. There is an art to doing that. There's a way to do it. I've done it for some time. I remember doing classroom presentations, and dude, every time we got a group presentation, I was like the best in my group. And I like even my teammates, they would know, oh, when we go to present, Amit's going to crush it every time. That's how I knew I had a knack for communication. I would present in like 7th grade. Like you would have to do PowerPoint presentations. Dude, I would fucking crush the presentation. Like when I mean crush, I mean my teachers would just like, they were like, how is this kid standing in front of the class and like presenting in the way that he's presenting? And I just loved it. I was never afraid of the moment. Sometimes in those presentations, you have some hiccups. You're not really sure what you have to say. And so you make a little bit of a joke. Like I remember one time I made this joke about Biggie, and I was doing like a financial presentation, and I was like, I'm not like Biggie, but sometimes you get mo money, mo problems, which is a line from one of his famous songs. And my teacher, she was just really impressed because I was a young kid talking about a rap song in the middle of a financial presentation. It's just like you gotta allow the nuance to make you personable, to sound exciting, to sound like people actually care about you, to get people engaged, there's a whole art to public speaking and communication and presentations. So far right here at 727. And I think CEOs need to be number one in the country, especially if they have public companies, of presenting their ideas. If you cannot present your ideas, you're just, I don't think you're going to get enough people to believe in your ideas, whether it's employees, investors, customers. Like you got to get people to buy in. And Alex Karp, one of the reasons I respect him so much is because this man can sell a fucking story. He knows the stock is overvalued. You don't think Karp knows that, all right, 212 PE, 25 times price of sales, it's a bit pricey right now. But he knows the reason they're getting that premium is because he can talk. And he can get people to believe in his ideas. Nvidia is down below 107 right here. Nvidia 107.10. Yeah, Nvidia just dipped to 106.33. IWM, are they still green? IWM 222. That's still green as well. So talking is important. Same thing with Vlad. Like Vlad is not the best talker, by the way. Robin to 2104. Vlad is not like the greatest communicator, but he has a little bit of personality. He's a little funny. He's not that emotional. So he'll try to like get through his argument and like make a core point. He'll throw jabs at the Schwabs and the Fidelities. That like he'll throw a jab without sounding like he's throwing a jab, right? So there's a nuance to it. So if you can talk and get people to listen, it's just easier for you to sell. And I think Noto has to be able to do that in the context of SoFi. I have a bad feeling about AMD. I have a bad feeling about AMD as well, dude. Let me show you guys Gene Munster. I thought his take yesterday on Microsoft was important. I have a bad feeling about Microsoft and AMD, not because I think they're going to have a bad earnings, but because the comps are a bit higher than expected. And I thought his take yesterday was really good. And so if Microsoft doesn't hit certain percentage points, the street might just sell them off. Same thing in the context of of AMD, which hasn't had good numbers for the past 2 quarters. Now, granted, AMD is down 12% year to date. Microsoft is down a little bit over the past month, so we are getting into some weakness, but I think they got to hit their numbers for the stock market to really give them a multiple. What happens if Karp left Palantir? I would sell my Palantir shares, dude, pretty quickly. I would be gone. Karp is a big part of the thesis, and he should be, and given Karp has no wife, no kids, he's dedicated 20 years of his life to this. I don't think he's quitting anytime soon. I think he's going to be there for the next 10 years, dude. I think he's going to run this ship. I think he's going to try to get the company to be worth like 500 billion, and then he leaves. Right now we're at 50 billion. He did say the company could be 20 times bigger than what it was in 2021, which would imply around a $500 billion market cap. So I think he stays at least for the next, at least 5 years, if not 10. But if he left, that would be a bit, because I don't trust anyone else to run that company at the CEO position other than Karp. All right, here's Deepwater Gene Munster on a lot of stuff from yesterday, along with CrowdStrike. So let's listen to him, and then we'll keep going from there.
Mentioned Gene Munster, managing partner of Deepwater Asset Management. Gene, great to have you with us. What is your initial take on this news?
I'm right lockstep with Guy on this one. I think that this is a rounding error. And you think about the Microsoft quarter, what's orbiting around it is several topics. We've got the CrowdStrike, the outage piece. That is something that will be in litigation probably for a long time. There's also cyber insurance. They could claim act of God. We're a long way away from resolution, and probably a long way away from Microsoft tomorrow talking about any specifics around this. My guess is that they will say something like this is going to have a minimal impact on the business, and there is low probability that they're going to venture an actual number around it. So that's one topic that's orbiting the quarter. The other topics, of course, is related to AI, Azure, and how they're starting to monetize Copilot 360. And I think when you kind of put all this together, I think the CrowdStrike piece, the outage piece, I think it's probably fourth on the list in terms of what's on investors' mind going into tomorrow.
I do want to talk more about Microsoft in the quarter, Gene, but I'm just curious, as a tech investor, how do you look at CrowdStrike? I mean, it's supposedly best in class in its sector, but the damage to it is not just in the damage to recurring bookings, but also potentially in liabilities. Is it tempting to you?
Not yet. We had owned CrowdStrike up until about a month or two ago, and we didn't anticipate this happening. Our sell discipline was around more valuation. And so, but we know the company really well, and we have not stepped in. And I think in this case, you really need to see a flushing out. It typically takes a couple quarters. We'll see a step down. We'll probably see another step down again. And I think once you get 2 quarters of bad news in, once they report their December quarter, I think that's probably the point where you have a good sense about really what the impact of the issue has been on their business.
Gene, let's go back to Microsoft for a second. Amongst the many things that people will look at, what's going to stand out to you in terms of the one thing that will move the needle in terms of market reaction?
It's all going to come down to Azure growth. I mean, that truly is the pressure point. The bogey number here is above 30%. That number is important because Google Cloud grew their June quarter by 29%. Last quarter, Azure grew at 31%. The street's looking for just over 30% growth. As long as they can show that they're continuing to gain market share, I think Microsoft investors are going to generally view this as favorable. I think that the flip side is if that dips below 29%, there's a whole new narrative that starts to emerge. So I think that that's probably the biggest. And then, of course, there's the CapEx second. But to answer your question, Guy, it's all about Azure.
Hey, Gene, this is Julie. I was curious what you thought. There have been various reports of what is the AI software attach rate to, what the cloud Azure spend is. I've heard, for every $100, it would be $40 of AI spend. Do you have any sense of if we'll hear anything about that more concretely and what we should be thinking about in terms of battle testing that number?
So the Copilot piece this kind of falls in the category of what's been generally disappointing around software and AI is we just haven't seen the uptake. We saw a little bit of good news from ServiceNow last week, but in general, to put some numbers around that, they're about 360 is kind of the magic number. They're about 365 million Copilot users or Office 365 users, conveniently those numbers. And if you think about what that impact has been, they've said to slowly expect this over the next several quarters and several years. But some quick perspective, if they add 1%, if they convert 1% of that base, it's about $360 a year, and that would add about 0.5% to their revenue. So the bottom line is this: AI is going to be throughout all Microsoft's products, but don't expect any sort of magical lift to happen tomorrow night. I think that they will continue to tamp down expectations relative to the impact of Copilot 360.
Sounds like you think the stock's going to go lower, Gene, or am I just imputing that on what you're saying? Because if they're
I don't know if
going to
it's
tamp
lower.
down expectations and it's only going to be
think
30% growth rate on Azure, I mean, 31% is the company's guidance. I don't see anything that's going to make the stock go up.
Well, I could be wrong, and we could see a better Azure number. I think probably that's something that could make the stock go up, because that's the most important piece. Is at Deepwater we don't own Microsoft right now. I think that there are other companies to own. I just put one piece. So we don't own it. We think there are better places to invest. And I think it comes back to a topic that we continue to discuss, which is to what degree do you believe in AI? If you think that AI is going to be transformative in line or exceed the hype that's out there, then Microsoft's going to continue to do well. But I still think that there are other companies, Google, Meta, Apple, that are going to do better.
I thought that preview was fair. Again, it speaks to the nervousness of Microsoft hitting their numbers in a very strong way. One thing as well, guys, is that we have JPal speaking tomorrow. So the fact that PayPal is holding on is just incredible. But SoFi going down is probably also because the market's a bit scared of what JPal is going to say. PayPal still up 7%. I mean, it's not. It gave back about 3% up when it was up 10%, but still up 7% right now. So I would imagine that if AMD, Starbucks, Pinterest, Microsoft after hours, I'll be live at 3:45. They don't have the best earnings, and we've got JPow tomorrow. There's going to be a lot of fear baked in, and we could see some dramatic moves to the downside. Now, if they have really good earnings, but we still have JPow speaking tomorrow, maybe the upside is a bit capped, not only because those stocks are up a lot year to date besides AMD, but because the market's afraid of buying anything before JPow speaks. Either JPow is super dovish tomorrow and we'll know, we will actually know, or JPow is like, well, maybe we need to get more data. Like we don't need any more of that data stuff, dude. We need JPow to say, yeah, we probably shouldn't wait to cut rates until inflation's 2%. Kind of the stuff he was saying on that congressional testimony. And that stuff, if he says on that stage, the market's gonna get more excited. If not, I think I think we're not going to factor in the rate cut until we see it. But if JPow says it, maybe the market factors it in before we actually get the cut. Chad says, except for Microsoft is deploying Copilot bullshit. Well, that's the other thing about Copilot. I mean, at the end of the day, the Copilot penetration should be percentage points higher than it was not only last quarter, but double-digit percentage points higher than it was Q2 in 2023 when Copilot was like just getting started. But they've also got to convince the street that Copilot is actually worth paying for. Remember, there's 360 million Microsoft Office users that are paying, I don't know exactly how much they're paying, but they're paying a subscription per year. Copilot is $30 extra a month. So if you could get 3 million out of those 360 million, right? If you can get 1%, 2% to pay an extra $30 a month, that does help top line and the bottom line. And if you could get that to be 10% or 15% over the next 5-6 years and really prove that having this AI assistant working with you in Sheets or Excel or whatever you're doing, emailing, all that stuff, that is a tailwind for productivity. That's Microsoft's bull case. The problem is we haven't seen that type of monetization of Copilot happen yet at all. It's like getting there, but it's not really in the numbers starting to be as expansive. Now, AI Cloud for Azure, that's growing aggressively. And it's up 30% every single quarter, which is great. And Google was just at 30% as well. AWS, I think, is closer to like 15 to 18%. So, I mean, like cloud is growing, which is the main AI piece. But again, AI Cloud doesn't matter unless the workloads on the cloud are producing results. And one of those workloads is Copilot, is ChatGPT, right? Is this AI agent assistant that you're using for everything. So if Microsoft can't get their own Copilot to exist within the enterprise, given Microsoft sells the most to the enterprise, they can't really justify other AI monetization streams happening over the next decade. And so that's, I think, a number the streets are really going to care about, even if they don't get the exact number they want today. Palantir down 2.25%, 26.47. SoFi 7.19. Now SoFi is down 2% on the day. Robinhood $20.70. Robinhood, I think it's a buy the dip right now. I think could it go below 20? Sure. If the broader market collapses, that's definitely possible. But I did buy the dip on Robinhood yesterday. I bought another option, a call option on Robinhood. when it was like at 21.05. So I did slightly buy the dip yesterday. Microsoft at 423, IWM at 221, KRE at 58, TFC at 44. So the only thing that's green today are the airlines. JetBlue, I think, is still up right now. JetBlue, up 19%. It was at 730, now it's at 708. And IWM, small caps, just went red. Regionals are green. IWM just went red. The NASDAQ is red, down 1%. Oh, there you go. We got 1% down, folks, on the NASDAQ. S&P down almost 1%, 0.6%. So we're getting into some bloody territory. Nvidia's down 6.3. Holy crap. I didn't even see that. I feel like we haven't looked at Nvidia in like 20 minutes or something. CrowdStrike's down 10% today. Yeah, but that was expected. That's fine. That it's getting rid of a lot of the froth in CrowdStrike and maybe goes lower. CrowdStrike's not that surprising. I mean, like down 10% is crazy, but Nvidia down, dude, Nvidia just lost $150 billion in market cap. That one is the one that hurts a lot more. That one's taking down the NASDAQ with it. Wow. Yeah, the only green I see is JetBlue, PayPal. What an odd combination. JetBlue, PayPal, and regional banks. You can make sense of all three of those, but still. And McDonald's is slightly green. Got Delta green. Apple's red. Chipotle is green. Texas Roadhouse is green. Shopify slightly green. Uber slightly green because Tesla's down. Carnival Cruise, that's up a little bit. Everything else is red, bro. The crypto stocks have to be all red. Yep, crypto's all red. All red. Coinbase is down 3%. Coinbase was almost at 260 yesterday. Now it's at 226. One of the best stocks to wheel for premium is Coinbase because the premiums are ridiculous, the upside or the downside. But if you end up, bag holding a lot of shares, if Bitcoin takes a bear cycle, that's the part that sucks about Coinbase. But even then, if you can reduce your average and you can capture good premium, because people are always willing to give alpha on the covered calls and cash care puts on Coinbase just because it's a Bitcoin proxy. But you got to be comfortable owning it for the long term because you're probably going to have to DCA a lot if you end up getting assigned on puts. Whole market's getting wrecked today. Yeah, Cisco's green. Cisco's slightly green on the day. Guys, I went to the Brooklyn Bridge yesterday with my mom and my sister. We did like a little trip to New York after the market closed yesterday, and people were out, dude. It didn't feel like there was a recession. Now, I know it's New York, and a lot of them were hipsters and tourists and stuff, but people were out, and they were eating and drinking, and there's the Brooklyn Bridge. I told myself I need to be more grateful for the fact that I live an hour away from this place, because I saw all these like foreign exchange students who were like so happy to like be in front of the skyline, and they were making TikToks and all this shit, and they had to come from like Morocco or Spain or somewhere. And like sometimes you forget this is like the greatest city in the world and it's right in front of you. But I paid $9 for a microscopic, I couldn't even say that word right, microscopic cup of ice cream. So, I mean, like in New York, there's no recession, bro. Like New York, people are spending. People can afford to buy $9 worth of a small little cup of ice cream. However, in the broader economy, there may be a little bit more of an issue. So it's showing the divide between a more wealthier place like New York City, where there's a lot of tourism, etc., and other parts of the country that are not, benefiting from all that. So and we might be having a little bit of a bifurcated America in terms of the state of the consumer. And the stock market eventually is going to reflect that over time. And hopefully a rate cut also helps to make sure that bifurcation isn't as bad as it gets. Greatest city in the world is Tokyo. NYC is third rate. Okay, so Tokyo is better in terms of the innovation, like the metro, the cleanliness. There's not a ton of rats running around, I would imagine. But the magic of New York is what's special about it. It's not the cleanliness of New York, it's the magic of it. But I agree with you. There are other cities that are obviously much, much more like innovative. But New York is still magical, dude. It's still magical. I also agree. New York's a little overrated. I'm not going to lie, but there's still something magical to New York. Even it's like a stock that's a little overvalued, but you still like, it's New York, dude. Look at the skyline, dude. This is beautiful. This is beautiful. You don't get this anywhere else in the world. This is absolutely gorgeous. And at night when it lights up, like think about this, like a first date with the skyline. I mean, come on, bro. There's not that many places in the world where you can do that. So Dubai's good. London's good as well. I've never been to those places. I want to go there. I could have gone to Dubai in 2015, but I ended up not going. But yeah, I want to get on the Burj Khalifa. I want to get now. I'm starting to realize, dude, as I've grown older, I have a fear of heights. It's not like a phobia, but like I'll be scrolling Instagram and there'll be like a video that pops up of someone like bungee jumping or someone these really weird videos where someone's jumping from one building to the next building, and in between there's like, you know, like they die if they fall and they'll still do the jump. And I see these videos and I'm curious to see if they make the jump, because I don't want to, like, you know, I want to see if they that's obviously why they're doing it, right? To get my attention. But then when they make the jump, dude, I like almost drop my phone. Like I think as I get older, I'm having a fear of heights, and I don't know why. Like I did so many roller coasters when I was young and I wanted to go skydiving. I never ended up going skydiving. But now if you ask me, hey, do you want to live on the 50th floor of like a condo in New York City? I would have to think twice about that, dude, because it's kind of scary looking out the balcony and seeing like, you know, seeing that you could fall. Nvidia 105. So I don't know. It's weird. It's like a new kind of like, I get jitters when I see big heights. And it's different from when I was younger. It's quite normal to not be into that. Yeah, but I was into that when I was younger, dude. So I think I started to fear death a little bit more. And it's more, you're more likely to die if you're like that up high. Like quite literally, objectively, you're more likely to die if you're that up high. Not saying that you're going to jump off or anything, but like, what if something happens, an earthquake or something, and you're that high and like, you know, you fall. So technically you're more likely to die. And I guess that's like factoring into like, well, why would I put myself in that position? Let me just like get on the second floor. Like that's, that's not too bad. So I don't know. But I used to like heights when I was younger. I really liked heights. The older you get, bro, the worse your stomach gets. I'm almost 40 years old and do not like heights anymore. Yeah, I think it's an age thing. Have you watched Free Soul, the Alex Honnold documentary? Yeah, for those that haven't watched or heard of Alex Honnold, dude, this guy, see, when I was younger, I thought he was cool. Now I look at him and I'm like, I cannot believe he climbs mountains with no strap, with his bare hands, bro. With his bare hands. Let me show you guys a picture. You could die from a bike ride. That's true. You could also die from a bike ride. Look at this. No strap. Just climbing a mountain casually. I mean, like, I just like if he falls, he's dead. Like, look at this shit, dude. This is like, it's kind of crazy. I can't imagine it. Like, dude, could you imagine doing that? Could you imagine doing that? And like trying to figure out where your feet go? Like, bro, this is just like, I have so much respect in the world for people that do that, but it scares me more and more as I get older. Palm sweating just by looking at it, right? It's insane. Does he know if he falls, he's dead? Yeah, dude. Like no, it's real, dude. Look him up on YouTube. He's done, I think, I don't know how many mountains he's done, but he's done some of the big, he hasn't done Mount Everest and he hasn't done Kilimanjaro, but he's done some pretty crazy mountains. And his girlfriend, like, you know, I think his girlfriend was interviewed once. She was just like, yeah, I trust him. It's just like, you know, some girls are worried about their guys texting other girls. It's like his girl is worried about him, like making sure his hands hit the right fucking rock. Look at this shit, dude. This is just insane. So definitely look him up. He has a great documentary, inspiring, but definitely is a bit more scarier as I grow older now. Okay, cool. So that's it for me, guys. I got to get out of here. We've got a big market close today. Last check on the stock market. Nvidia 105 down 5.6, CrowdStrike 233 down 9.6, S&P 541, QQQ 459, recovering just a little bit. We got some green candles right there, but they're still red. IWM now going green. JetBlue 705, that's up 18%. PayPal 7.65, still up. Palantir 2668. They got upgraded by Citibank to $28, but they're down 2% on the day. SoFi 724 down 1.2%. And I think that's pretty much it. S&P 541 down a little bit, down 0.53% on the day. Let's see what happens. We've got 4 hours until the market close. And let's see if Microsoft can save the day. It's really all eyes on Microsoft at this point. All right, word of the day. Word of the day is credo.
Credo.
a system of principles or beliefs. I think I knew this word. The company's credo, customer first, guides every decision they make. She lived by the credo that hard work and perseverance would lead to success. Okay, so my credo on existence is that you don't eat mayonnaise. That is a system of principle or beliefs that I stand with. You don't eat anything like mayonnaise. You don't eat anything adjacent to mayonnaise. I mean, dude, like, if I was a girl and I still had my personality, there's only one white thing that I would eat, okay? And it's definitely not mayonnaise. And that's how we're ending the show. Thank you, everybody, for being here. I'll see you guys at 3:45 p.m. on the market close. Big show today. Bye, everyone. See you later.